very good morning and welcome to Trade Live with IG. It is Wednesday, the 23rd of July. Mini Cooper, the Lionesses in the final of the football.
Yes. How are you celebrating, Rich?
Well, I don't know. Shall we take the next couple of days off?
Well, we got Thursday, Friday off. Happy days.
That's also the next couple of days.
4-day weekend. What are you going to be doing?
I don't know. I might pop across to Ibiza.
Pop across to Ibiza?
Yeah. Bit of dancing. What are you going to do with yours?
Nothing interesting. I'm going to go and see my mum. She's going to cook me a nice meal. I don't know what yet. I'm going to go to the dentist and I'm going to spend some time with my little brother.
We've got quite similar weekends in order.
Why didn't you invite me to Ibiza, Rich?
Oh, mate, I'll tell you what.
How come was it too late?
I will even pay your flight. That's like a stag do when you get the silly person to come along with you.
Someone's got to teach you how to dance there, right? I've seen Rich dancing and singing to Justin Bieber this morning. I'll tell you, it was not a nice sight, people.
Dad dancing. What's wrong with dad dancing? So good morning to you all. Yes, we have the full team in the studio today. We've got a brand new signing, Seb, joining us as our new video editor and social media superstar.
Superstar. Very nice.
Just you wait until you see what is coming to us on our YouTube and social media. And we've got the wonderful Terence and Cam with us in the studio as well. And I think, is producer Phil, is he here this morning?
Is he here this morning?
Not sure. He wasn't here yesterday. Right, let's see what's coming up. Has he managed to get the slides up and ready for us? Oh, he has. Look at that. Mini Cooper, what is coming up on today's show?
Let's go. So overnight action and opening bell and fast markets will be myself and Rich. Woo. And then at 8:30 we've got charting crypto with the one and only Chris Beecham. Shout out to Chris for helping out with the workshop yesterday. 9 we have got all sessions opening bell with Rich and Ange. 9:10 we've got expert edge with Ange and Dylan Rattigan. And then at 9:35 we've got Rich again with Arts of Investing episode 1.
In our very first podcast. So the government has asked, how do we get a nation of savers investing? And the answer is to watch our podcast today at 9:35.
There we go.
Where, of course, the wonderful Chris Fellingham and Mark Holden join me from their 40 years each of experience.
Sorry, I've just seen this in the comments. Ibiza versus Mini Cooper's mum. I don't know what that
Wow.
mean?
And that's from Angeline.
Wait, what does that mean? I'm taken back by this.
Angeline's wondering which she would choose, Minnie.
Right, okay, I was just... Okay, sorry, Rich.
You have me lost for words sometimes. Right, good stuff. So let's look at what has been happening overnight and some overnight action. It's all about Japan. Wow, what an incredible move we've seen across there. So let's have a look at the overnight moves with our brand new graphic that we're going to be bringing you every morning. We're very excited to look at the Japanese moves.
Let's have a look.
And that has been quite... Here we go. So the Nikkei jumps 3.2% on the back of a US-Japan trade deal.
Yep.
Where the main details are they're cutting the tariffs on Japan to 15% from the 25% that was threatened.
Yep.
I just don't think I'd be that happy with 15%. But the main positive, the reason why Japan has said yes, is because the autos tariff is included in that. So the autos will be at 15%.
Like Toyota share price shot up.
Tell us some of the moves.
Shot up. So what I've got here is I've got it prepared. I've got a little bit of summary from Bloomberg AI. So the deal includes a $550 billion fund to make investments in the US, with Japan agreeing to provide the funds to invest in projects in America. And then in addition, Japan will also buy 100 Boeing aircraft boost rice purchases and buy $8 billion in agricultural and other products, while hiking defense spending with American firms.
So defense and what's the other one? The defense and steel is not included. Steel will remain a 50% tariff, and the deal overall, because Trump has said this is the. Shall we do the Trump impression? Where's our Trump voice? This is the biggest, biggity, beautiful trade deal in the history.
The one big, beautiful bill.
So this is the one big, beautiful trade deal, the biggest in history in the universe. Because it's $550 billion of Japanese investment and loans to the US. So there's a whole hodgepodge in there. Of course, a lot of it is just trying to grab the headlines.
Yeah.
But the main one is 15% tariff on all Japanese goods.
Love the tariffs.
There we go. That's what I was looking for.
Including the automobiles.
Including the automobiles. And the automobiles are important because they are 28% of US exports Japanese exports into the US. What has that done to the share prices of Japanese autos, I hear you ask? Nissan up 8.6% in a day. Up 8.6. Now, that's important for us because, of course, if we're looking at Renault owns 35% of Nissan, so that should see a positive reaction this morning to help it from its profit warning woes of last week. Toyota up 14.6%, Honda up 11%, Mazda up 17%. Doesn't really do anything for the rest.
No, but I had a look at the...
as in the rest of the global markets.
Yeah.
Because I don't think 15% is that great.
Well, I mean, it seems like from this that the US have got a pretty good deal due to the fact that Japan are going to invest $550 billion and the fact that they're going to buy 100 Boeing aircraft. Of course, Boeing is US firm.
Which was clearly going to happen anyway.
Yeah, but yeah.
Where else are they going to buy from? Airbus. It's like, we just stick that in the bottom.
Yeah, so yeah, it seems like from what I can see, US have got a better deal than what Japan did.
Yeah, would agree with you there. But the Nikkei breaking out. The Nikkei very happy with it, up 3.2%. Let's have a look at the rest of these futures then. Oh, what a day yesterday. US S&P 500 trading 62.90, but recovering to close above 6,300. Another all-time high without NVIDIA, without Palantir. Those were both down 2%. So we were seeing big rotation. And this is what we've been talking about, the extension of the breadth taking the market higher rather than those favorites that are fully valued, such as the two that I mentioned. FTSE up and away.
Well,
We have got the rocket boosters under us now.
there'll be 9,500 soon.
You say that as if it's funny.
It's funny.
Why is that a joke?
I don't know. I think it's just like the UK FTSE. I'm just not too optimistic.
Get with it. Get with it, buddy.
I think you're too optimistic about the FTSE, Rich, like you are on Vodafone.
All right, let's have a look. What is the FTSE 100 up this year?
From 1st of Jan.
That's this year.
No.
Yes, let's go.
All right, then.
Without
I'll
looking,
go.
people, this reaction of Mini Cooper is exactly the reaction throughout
7-8%.
the country. Exactly the
I'll go
reaction
7 or
throughout the
8%.
country that is causing people not to invest in our domestic stocks. And
know-
this is what the government has to change.
Do you know the answer to the top of your head?
Yes.
Right, I'm
I
going
know
to
the
guess.
exact number.
I'm going to guess 8%.
Right, what is... let's go for a poll. What is the
And you
FTSE
can't
up this
look.
year? No looking. Is it up 7%, 9%, 11%, or 13%?
So my 8%'s wrong.
Well, I'm going 7, 9, 11, 13.
Okay. But you just told me I'm wrong. Cheers, Rich.
Yeah. That's from the start of the year, yes. So, let's look at that. That poll is going to come up. Then we're going to have a look back on the screen, the DAX up 1% pre-market. So the DAX is seeing that, oh my goodness, these autos can be included in the trade deal and the tariffs can come lower.
Yeah.
So the autos are going to have a really good morning this morning. If that is very good, if that is included in the deal with Europe as well.
Yeah.
Right? Nobody really knew that was on the table. So that is a positive for the auto stocks this very morning. Gold up and away. Wow, didn't it move yesterday? 3,421. Remember, we were buying it at 3,365
3365
a couple of days ago. So that's really started to move. Bitcoin just dropping below the 120,000 level that it touched overnight. And then sterling 135.23. So that is your morning rundown. Copper also breaking to new highs on this move. $5.76 a pound and 9,870 per ton. Right.
Cool. Should we go to the news from yesterday?
Let's do it.
Let's start with General Motors then, as we're on the topic of cars.
Yeah.
Is it okay if you bring the price chart up for me, please?
I will do that for you, sir.
2 p.m. yesterday.
My Padawan.
Padawan. Sam Peach called me Padawan yesterday as well. I was quite taken back by it.
Starting to take to.
That'd be my new name.
How is Sam? I hear he's been eating vegan cakes and things.
Yeah, so we had the workshop yesterday, and
well, explain to everybody what the workshop is.
Sure. So we have a premium client workshop where we have every month around 10 or 11 clients. They come to the office and we do a session, and this session includes market analysis with Chris. Chris kindly helped out yesterday and did technical analysis due to the fact that Axel's on holiday.
Nice.
We also illustrate our new cash crypto product, and then we also have a talk with the desk and they show how they hedge from their side, because a common misconception is that we trade against a client.
Yeah.
That isn't the case. We actually go into the market and hedge in most cases. So therefore, we want clients to win, so they trade more due to the fact that our business model is we make money off the spreads and commissions. So we host a day, and on this day, of course, we order food in.
And it is a proper spread as well.
Yeah, really, really, really good food.
Didn't get the invite.
You're in a meeting. You're in a meeting, Rich. Come on, don't be like that. And there was a lot of cake left over, okay? And we had vegetarian, vegan, halal among these options.
Yeah.
And there was a lot of vegan cake left over. And I came in this morning and half of it was eaten. And it was on Sam Peach's desk, this vegan cake. Because he's got like this new health kick as such. And he wants
Sam does as well.
Yeah, like vegan,
Ronnie is
vegetarian. Yeah, so maybe it's both of them, but I don't know. But it's, the health stuff isn't for me, but Sam...
Well, you don't need to yet.
No.
You give it 5 years.
Sam with all this cake on the desk this morning, I was just a bit taken back by it, to be honest. I was rather upset.
Yeah.
So was Pete as well.
You said because you have him up on this pedestal and you
Cake at 7 in the morning. It's not normal, is it, Rich? Back to General Motors. I don't want to get in too much trouble.
Go on then.
So if you go on the price chart, if you go at see you on the daily, if you go on like a 15-minute to 2 p.m. yesterday.
Okay, let's go on 15 minutes for you.
2 p.m. yesterday.
Oh dear! Wow.
Yeah. So I'm just bringing up the article.
Well, that tells the story. What time did the numbers come out?
It would have been what? So horrible to me, Rich. Okay, so General Motors announced on Tuesday that Donald Trump's tariff knocked $1.1 billion off its operating income in its last quarter. US automakers' second quarter core profit fell 32% to $3 billion and said it expected the tariff impact to worsen in the third quarter. The company stuck to a previous estimate that trade headwinds threatened to hit the bottom line by $4 billion to $5 billion US dollars. GM said it could take steps to mitigate at least 30% of that impact. Just a quick fact here on where vehicles were built last year. So GM built nearly 1 million vehicles in Canada and Mexico in 2024. So, it hasn't been a great performer, has it? No.
And then, so I guess we've still got Ford to come. I haven't seen results from them yet. So yeah, just a bit flatline there, isn't it? From still at the same share price it was back in 2021.
Yeah, because I remember. Well, obviously Trump got in on November the 5th, 2024, and ever since then, he's been coming out with his tariff announcements, constantly changing them. I remember General Motors specifically was one of the car makers who got absolutely hammered because obviously they weren't just doing it on cars; it was car parts as well.
Yeah.
So if you produce in the US, import the car parts from Mexico, let's say, then you're paying tax on them. So yeah, not ideal at all.
And we also had numbers from Coca-Cola.
Yeah.
Was that
Coca-Cola?
a bit more fizz in that one?
This one is 11:45. See, I've done my prep, Rich. I was in nice and early this morning. Nice and early. So my eyesight's obviously a bit bad, as you know. So that's a daily.
That's the daily, yep.
Yeah. If you go on like a 15-minute chart as an example,
Okay.
then you'd be able to see a sharp drop down at 11:45 UK time.
Yeah. So
Just go up got a nice little article ready here.
go on, we'll wait.
I'm just loading that up. Okay. So quarterly earnings and revenue did top analyst expectations. Of course, the share price has tanked. Strong demand in Europe offset weaker volume in other markets. Earnings per share 87 cents adjusted versus 83 cents expected. Revenue was 12.62 billion US dollars adjusted versus a 12.54 billion expected.
So just not great. And I think that's the interesting theme, is that the two big ones that have now reported, GM and Coca-Cola, it's been a negative reaction, right?
Yes,
so we saw the great numbers from the banks last week. Of course, banks are the best at managing the street's expectations. But now we get into real America, then you're seeing, despite the currency benefits, you're seeing stocks come off so far.
Because with Coca-Cola, when they reported in Q1, their numbers in the US and Europe were quite weak. And you could make the case that now we're shifting towards a more, how should I say, it's like a more like health aware as such. Of course, Coca-Cola is
from Sam.
I hope he's not watching. Of course, Coca-Cola not being very healthy. And I was also reading a statement on Coca-Cola's website saying, of course, how they're aware that a lot of their business is in developed nations, such as in US and the countries within Europe, and they want to try and focus more on Asia.
Right.
So they're going to try and build from the bottom up there and go from there. Because obviously that's a big market, a very big market. Asia, China, India.
Well, there we go. So Jefferies have raised their target price on Coca-Cola to 84 from 83. And then Anne's just telling us, along with that, Richemont, Deutsche Bank have cut the target price to 145 from 150. But yeah, it doesn't look like there's anything too big this morning on the upgrades, downgrades. Right, let's go to the front page of the Times then. We haven't looked at that one this morning. And there is a warning from the Bank of England saying, Rachel, deregulation risks financial crisis. So be careful with all this deregulation because you are risking financial crisis. Andrew Bailey also goes on to tell everybody that the most crowded trade in financial markets at the moment is to be short dollar, which I thought was particularly interesting. I've never heard the governor of the Bank of England tell everybody what the crowded trade is. So he told, this was in a 2-hour meeting with Treasury Select Committee yesterday, saying, Rachel Reeves, just be careful. This deregulation, if it goes through too quickly and the changes are too widespread, then are we going back to a 2008 situation?
Let's hope not. Jesus Christ.
But that's his job, not Jesus, Andrew Bailey, to stop us getting into more trouble. Maybe it applies to Jesus as well. Yeah. Right, we've got.
Talk about Philip Morris International as well.
Well, first let's stick with Europe. Let's look at SAP. So SAP has had numbers. The cloud revenue was up 24%, but they did miss forecasts. So SAP dropping yesterday in the US. They've got an ADR as well. So we need to watch that one. But yet again, it underlines how crap European tech names are. ASML has been a disaster since it reported.
Still in the US, all in the US, which we can talk about a bit later because I want to talk about Alphabet and their investment in AI. So we'll talk about that 8:15, right?
8:15. We're going to preview those for today, 9 p.m.
Yep. Busy evening.
And yeah, and then one other thing in Europe, UniCredit has raised its guidance. So good numbers from UniCredit, but it has dropped its bids for rival Banco BPM. So Italian bank consolidation not happening, but the good numbers continue. Right, poll results are in, you FTSE doubter, you. How much is the FTSE up since last year? Now, 84% of you are correct. And how does that happen? Well, at headline level, it is up 11%. So 54% of you in the majority were correct. But don't forget to add back your dividends. You've also earned about 1.7% of dividends because it is July. You might not have been paid them yet, but you've earned them. So therefore, it's actually nearer to 13%. What is the S&P 500 up? If you are a UK citizen holding it in GBP, how much is the S&P 500 up this year? FTSE, we said the FTSE's up 13. The one that you find boring and have no interest in investing.
Right, so in that case, I'm going to say 10%.
4%.
4%.
4% for your glorious American market.
Why are you so angry at me?
Because you just rolled your eyes when you said about investing in the FTSE. That's our whole job, is to bring the beautiful thing that is UK investing to the people. None of this chasing 24 times earnings S&P 500 rubbish.
It's because when you invest in UK shares, when you invest, you've got to pay stamp duty of 0.5% on the buy side.
Okay, so
Therefore,
only
the government needs to remove that, and then I'll be happier.
So the 9% outperformance of the FTSE this year against the S&P 500 in GBP terms.
That's all I'm saying.
You're bothered about that.
That's all I'm saying. That's all I'm saying.
No, I agree with you.
And
you're right.
More UK investment.
You know, I'm just choking your chain. Right, let's at 7:52. It is time for chart of the day. And Nadine Holland, you were spot on. 3 to 4%. No, the S&P is not up 7.7 in GBP terms. So right, let's look at the chart of the day. What is it? UK stock. What's producer Phil going to have in his head as a UK stock? Come on. I think it's going to be something along the lines of industrial.
I will go with, I can't remember the story.
I think he's been through all the consumers.
On the Times, we didn't go over it in the top right-hand corner. I don't remember the story. AstraZeneca was on there, so I'll go with that. Right,
you go AstraZeneca. I changed my industrial. I'll go, one of the mining stocks.
Fresnillo have got sales and results out this morning, so it could be that.
That's the kind of thing you'd go for. Right, let's go. Who's going to get it first? Gavin Ackers has been very quick. Hamish is up there. So who is going to be first? Are you going to get beat by Mini Cooper?
I'll go with Fresnillo.
He cheated. He tricked us all. He's put up a UK stock, but then put the Johannesburg price on it because it is dual listed in the UK and Joburg. Well, he's trying to stop people putting it into AI, and he wants them to guess it just on the pattern of the chart. I would never have got this one.
Well, what's the punishment? What's the punishment? You can't get away with that. That's cheating. I know he hasn't won in a month, but that's his fault. It's not the viewer's fault, right?
Technically, it is the same chart. But yeah, not happy. It is Mondi. Mondi, well, put up my screen and then people can see it in the actual currency that it's meant to be in. Mondi, there it is. Go and flick between the two and let's see if it's the same. Yeah. Oh, back to 2023. Okay, let's see. 2023. There you go. Does it match? Yeah, it matches close enough. Boo! That's how desperate he was for the win.
But you got it. You got it.
Yeah. Well done. Right. Okay. So we have got 1 minute. What are we looking at this morning in the UK?
Fresnillo. We've got news on Fresnillo.
Solid Q2 production. Gold production trending at the upper end of full year guidance. Full year outlook remains in line with previous guidance. Downgraded away, down 2%.
We've got Informa, adjusted operating profit beats estimates. FRP Advisory Group, full year results. A trading statement from Wilmington PLC. That was the main news out in the UK this morning, and also got a Weatherspoon pre-close trading update. Which
go on, tell us Weatherspoons.
So pre-close trading updates. Like-for-like sales increased by 5.1% in the 12 weeks of 20th of July 2025 compared to the same period last year. Year-to-date, like-for-like sales increased by 5.1%.
This is, right, get your bell in your hand. This is the one I would have bought Weatherspoons if I had just been trading on weather reports alone, and how beautiful. Go on.
Oh my God. Who broke the bell beforehand?
Guess who? Your wonderful boss.
Oh, was he not going to replace it?
Yeah, Pete Ward, replace our bell. Right, Weatherspoons down 3.72. Thank goodness I know better than to trade on weather alone. Right, up on the day. Take us through it, Mini Cooper.
So we got British Land up 0.88%. Watches of Switzerland's group up 0.84%. We've got Barrett Redrow up 0.79%. Whitbread up 0.78%. Kingfisher PLC up 0.73%. UK Bank there, we've got NatWest up 0.72%. Oh, we've got Vodafone, 0.45% up.
Go on, say it again.
Vodafone
say it again.
Up 0.45%. I want to.
So that would be 25% in the year to date. 25%, Mini Cooper.
Not bad if you were long.
Adding back in the dividend, it is 86.
Did Vodafone pay a good dividend, Rich? BP up 0.74%.
Yeah, that's about it on the upside. Let's
as well.
What about the losers of the day with the FTSE at new all-time highs? What are you seeing?
So we got Fresnillo, who released sales results this morning, down 1.84%. Weatherspoons now down minus 3.72%. National Grid 0.83%. Anglo American 0.47%. Rio Tinto 0.37%.
Yeah, bit of softness there from the mining stocks, just with iron ore coming off overnight. Right, Ocado up 2%. We've got Glaxo up 1.7%. AstraZeneca up 1.5%. So that's, I guess there must be some generic pharmaceutical tariff news.
Yeah, there was something on the Times on AstraZeneca this morning, but it's just in the smaller section on the front page. I can't remember what it was about specifically.
Well, they were talking about investing $50 billion into the US.
Okay, that must be.
But still getting increased pressure on them to move to the US.
Oh, to list
the US.
Yeah.
Diageo up 1.5%. Diageo 1960 now. And
IAG up 1.11%. It's good to see. That was one of the first stocks I ever invested in.
Right, we've got that German auto story. Let's see where the German autos are. There they are, 3.5 to 4%.
Look at that. Mercedes up over 4%.
They have been on their knees. Will the European trade deal include lower auto tariffs as well? That would be a nice bit of respite.
We've got a Volkswagen also up just over 4% now. We've got Renault up 2.9%.
And Porsche up 5 now. So very strong morning there, as expected for the autos. Wouldn't take much to get them going even more. You know, they've had a few...
Porsche now, over 6%. Not bad at all. We've got Louis Vuitton up 2.17%.
That's right, Japan, a big sales destination there.
What else have you got? Simmons up 2.52%. Yeah, very, very positive. Very, very positive morning for the DAX.
Yeah, those autos could be anything at the end of the day. Right, on the downside, not too much.
Not too much. Just three stocks.
So let's go back to the UK. Let's see what is leading. Leading Fresnillo is the one leading them lower. Clearly not been taken well there, down 4.7% on the back of numbers. SSE, we said, bit too high yesterday, bit too quick on that move, on that upgrade, that it looks like the buyer has come to an end there. If we want to take a look at the 3-day chart on SSE, it was just a little bit excessive in there we go, the veracity of the move. Look at that. So I would imagine that has been a decent sized long fund buyer that is now
done very well.
Now done. Right. What about the?
I've just got some numbers on Fresnillo, given the movement. So the BFW stands for Bloomberg First Word, and it's just a summary of the RNS. So a brief overview of the results. So Fresnillo maintains FY silver production forecast, but the first half results were, I'll give you first half results and then second quarter results. So first half results were silver production was 24.88 million ounces, which is down 12% year on year. And gold production for the first half was 213,840 ounces, which is 16% up year on year. And then just for the second quarter, we've got silver production was 12.51 million ounces, down 15% year on year. And gold production was 157,735 ounces, which is up 21% year on year.
Good. Right, all the analysts taking down your notes there.
There we go.
And let's just have a look at commodities then, seen as Minnie's given you all the stats. We've got platinum up 50 basis points. That is joining the party that gold was having yesterday. I actually bought some gold miners yesterday.
Which ones did you buy?
Just the sector swap. So where is it? Where are my gold miners at? There they are. So the VanEck Gold Miners UCITS ETF, bought 300 of those, and also I bought 300 of the Junior Gold Miners ETF. So that just adding a bit of gold mining
exposure there
stocks, because this is a resurgence in gold from 3,350 up above 3,400, and I think that could well continue. And the miners haven't been incredible performers if we look back at the daily chart. Yeah, you're just at that point of, are we about to break above that? If that's the long-term chart, but if we look at recently, right, that is these gold miners taking advantage of those higher prices, and it's had a nice little cup and handle pattern. So playing that for a breakout, let's see if it happens. Kate Murphy's saying good morning everybody. Yay, Mini Cooper in the house.
Hey, shout out to Kate Murphy. I can't see the comments, but thank you very much.
There you go.
There we go. Vodafone swoosh, yeah. Yeah.
Yeah, caught short. Clearly not caught short on Vodafone. And we have Poppy. Good morning, Poppy.
Good morning.
All-time highs on the FTSE. What better for launching a portfolio for our podcast, The Art of Investing. Why the art? Well, all the computers can tell you about the science and the numbers behind it and spreadsheets. But investing takes an art.
Takes time.
Because sometimes there's things going on in the world and the markets will react one way.
Yeah.
But you've got to know where perception is, where investor psychology is. So there is definitely an art to it. And that's why we called it The Art of Investing. That's coming up at 9:35 for you today.
Interesting you say that, because like a lot of my friends who don't work in finance and don't have a lot of experience with investments, when Trump introduced the tariffs, I think it was April the 2nd off the top of my head when the market went warm. They were like, oh, I'm going to stop putting my so much every month in the S&P 500 track. And I was like, no, don't do that. Now's the time.
Put it into the FTSE is what you said.
No. But I will start promoting the FTSE from now on, okay?
Not promoting. We don't give advice here.
No, I meant to my friends.
You just show them the error of their ways. And the American exceptionalism is over. And now it's British exceptionalism.
Where do AstraZeneca on a list again?
Well, yeah, because Trump's bullying them and blackmailing them. That's why we have to stand up for this country. Right.
It's not like it's one of the stocks in the FTSE 100 which has the largest influence on the price, like BP, Shell, AstraZeneca.
Replaced with new upcoming
We'll
incredible companies from the FTSE 250, such
see.
as financial platforms.
Soon come will be in the FTSE 100.
Right, Big Mike. Now, here's an interesting one. Big Mike is building a short position in the FTSE, calling BS on the rally. Do you agree with him? Is this whole market a BS rally? And is it time to build shorts? That is certainly when we've seen this kind of excess before, then building a bit of a short position. I've certainly built a short position in the S&P 500. I've now got shorts in Palantir. I've got shorts in. I actually closed the Coinbase yesterday, so took a quick 4% on that. But Palantir, I'm going to run that.
With the S&P 500, what's like your time scale on it? Like, do you plan on? Is it like the next 2 weeks, or is it more longer term?
No. It's options. So I'm short the deck calls.
Right. Okay.
So for the S&P 500, at some point in the next 6 months, to trade lower than where it is today.
Okay. Yeah.
Which there is an 88% probability.
Yeah. I'd say that's quite a high probability that could happen for sure.
Andrew McKevie saying, no, the FTSE rally is long overdue. I do tend to agree. But is this rally a red herring overall? I believe so. I'm short. No. This strong, I'm long. Interesting.
I'm strong, I'm long.
Say it louder. Say it like you're proud, Minnie. Come on.
I'm strong, I'm long. That's so cringy.
There's our social media cut for the day.
What rally are we talking about? Says Jugger.
What rally are we talking about? The 13% one year to date, Jugger. Come on. So yeah, let's see. We've obviously got big numbers tomorrow coming in the shape, well, Vodafone for one, but will be big night tonight. So Google reporting the first of the big four or big five, depending if you also include Nvidia. First of the big five to report, and that is coming up. Our preview for Google tonight coming up in 3 minutes time. Should they like and subscribe, Minnie?
Of course. How many numbers are we on now?
1,300 subscribers from zero just a matter of months ago.
Every time I'm on here, the numbers are going up and up and up.
You might want to start telling your clients about it.
Oh, come on. One of my clients was on the show. Shout out to Mark Russell. And it was my birthday on the 9th of July. And he said happy birthday to me.
Ah,
Yeah.
bless.
So I was very happy with that. So thank you, Mark, if you're watching.
And that was your 21st?
21st. Do you remember you did a poll? We
Yeah,
did a
that's
poll,
right.
And everyone guessed, well, most people guessed my age correctly, which was I was turning 26.
Good to know.
Yeah.
Excellent. Right. We'll see you in a couple of minutes for Fast Markets.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Well, you're not going to get better than cash returns.
Today we're here because we've recently launched our Save Our Stock Market campaign. We just want to raise awareness for terrible cash returns that everyone is getting with their money just sat in cash ISAs. What we want to do is raise awareness for the great returns that you can get on UK stocks and help revive the UK stock market and get people investing.
There's a lot of bad feeling about the UK stock market, and it's really negating people's view on the UK market as a whole. There's some great companies. If we just start the ball rolling on people getting behind the UK stock market, then we can start to get the interest. And it's days like this, we get awareness of all the crowds talking about stocks. It's really that awareness, and ideally we'd like to take it to the government. We would like cash ISAs to be reduced, not because we don't believe in the chance of people saving, but more that you get higher returns, as much as 7 times historically, in investing that you can from cash. And that's not saying people go out and take a load of risk. It's about education, and it's about helping people to understand the benefits of investing and the limitations of holding their money in cash. We are back. Welcome back, everybody, to Fast Markets. And we are going to be looking at these huge stocks that are reporting tonight after hours. Now, on the Tasty platform, we have a beautiful preview. And there it is, Alphabet's earnings preview. Will AI search affect the bottom line? That's the question everybody will be asking. So, Minnie Cooper, run us through what you're seeing while we let the people read this on screen as well.
So just one thing to note was that last time Alphabet reported on the 24th of April, market reacted very, very positively. So in the first quarter of 2025, Google advertising revenues rose 8.5% year over year to $66.885 billion US, and that accounted for 74.1% of total revenue. YouTube's advertising revenues also improved 10.3% year over year to $8.972 billion US in the last quarter. Now, for the second quarter, where results will be reported on tonight.
Yeah, looking for an EPS of 214 and revenues of 79 billion, just over 79. Of course, they have to beat that. So you're really expecting about a 218 to 220, I would imagine.
However, one of the concerns on Wall Street is that Google search, which is of course owned by Alphabet, is poised to be potentially disrupted by generative AI. So interesting. If you were going to search for something, Rich, would you use Google or would you use ChatGPT or what would you use?
I still search on Google, but for anything that is an adult question, then it's ChatGPT, because you really find out how basic Google search is when you start to ask about, FTSE or about restaurants or where you're going. I just like the straight answer that you get from ChatGPT.
Even now at work, myself and a lot of the other premium account managers use something called Claude, even to research in some cases, information. If I want to learn about a stock which I didn't know too much about, then what I'd actually do is I'd go on there, and I'd look on Bloomberg as well. So I would also incorporate.
It must take you a lot of time then, all the stocks that you'd be looking at.
Yeah, of course I am.
Right, let's have a quick look on the Tasty platform then, because we know we can find out there what the expected move is. So I'm in play on this one because I'm long the set 185, 215 call ratio. So I'm long 2, short 4. So that's 200 shares, and then above 215, I would be short 200 shares. And I'm also short 2 of the puts down at 145. So we definitely want them to go up. My net delta is long on Google, and we see that here. About 14.6. So not crazy long, but I am long. So let's look at the expected move on the stock, and it is $10.
$10 up or down?
$10. So just over 5%.
I'd say that 5% isn't that big of a move personally. But
so what would your?
I'd say nowadays for tech stocks, just from being in the markets and looking at earnings, I'd say over 10%.
Yeah, I admit I think 5% is low, but also it's had a big run into it.
Yeah.
So you've taken some of the move beforehand. If it goes higher, if it goes down, you're right.
Yeah, I just feel like ever since Trump got in, and markets in general since he got in November last year, that a 5% move isn't as much as it once was, let's say 3 or 4 years ago.
Yeah, the market all-time highs. You're absolutely right, Minnie. Absolutely right. Very wise words there. So, especially as the stock has gone higher quite significantly from the lows. So if we go even from the start of July, you can see that we have moved from 170 to 192. So, if the numbers don't back that up, but everything that we're seeing would suggest that they're confident in the price action.
Well, Google have been plowing a lot of money into their cloud business, which is, of course, very important given their competitors, such as, let's say, Meta as well. Obviously, we've seen them trying to poach, I don't know the specific word for it, but would it be like a developer, someone who's like an expert as such in AI, and paying them silly amounts of money to join their team?
100 million.
Yeah, it's crazy. Or silly amounts of money just not to work elsewhere.
Yeah.
But it seems like Google Cloud are really going ahead and going full steam on the AI front. So we'll see how it develops.
So, so what we could see happen would be them back up at that 200 level, which is where Piers' shout is on the show yesterday, $200. And that would be our 5% move. So, right, moving on to Tesla. What have you got for us in the Tesla preview? These they've really gone to town on the picture work on.
I love it
on Tasty, haven't they? Brilliant.
Tesla. Q1 2025, I'll just go over them quickly. So revenue was $19.34 billion US, and earnings per share adjusted was 27 cents. Revenue expected for Q2 is $22.8 billion US, and that would be a roughly 11% decline from the $25.5 billion US in Q2 of 2024.
Right, so
the same period last year, of course.
Expected move 7% tonight.
7%.
So $23 and 7% move. There we go. 39 cents is what we're looking for. EPS of 39 cents tonight for Tesla, and 22.2 billion in revenue. That would be down from an EPS of 52 cents only 12 months ago. Oh my goodness, I didn't realize they were dropping in 15% drop in revenues.
Yeah, Tesla's had an awful year so far.
It really has,
awful. I'd say one of the main factors is, of course, there's been a slowing demand for electric vehicles. I know a lot of their competitors have cut back a lot of their targets with respect to electric vehicle production. You could argue that one of the primary reasons for this is due to the fact they're actually quite expensive. I mean, Tesla's expensive, and then going on to, let's say, BYD, they have a lot cheaper models, right? And in addition to that, BYD are grown in Europe, where Tesla are struggling. I mean, we saw in Germany how a lot of Tesla cars got vandalized.
Yeah, of course.
Mainly due to Musk.
The Germans hate him, yeah.
Yeah. Hate him. But yeah, BYD.
Oh, they hate him.
Yeah.
I
said that absolutely.
When you start
You
talking,
say it really strong.
yeah, the right wing commentary has been made. Doesn't tend to go down well in Germany due to its history. So right, that's the Tesla chart. Whoa, where do we sit? Mini Cooper, I am going to put it on you. You get to buy one and be short one out of Alphabet and Tesla. What are they? What's your long short?
Tesla.
Long Alphabet, short Tesla. I got to go with that.
Tesla. Yeah.
Got to go with that. Yeah. Right. So the poll that we're going to run is going to be a very complicated one.
Okay. I'm worried.
Right. Phil's gonna be right. So the last poll was: is this rally a red herring? It's very mixed. 36% saying strong and long. 36% saying only time will tell. And 27% are short. That is exactly what you'd hope to see. Very balanced. But let's go to the poll on tonight's earnings. You can have 4 choices: long both, short both. What's your positioning in Alphabet and Tesla for tonight? Long both.
Yeah.
Short both. Long Alphabet, short Tesla. Long Tesla, short Alphabet. That's your 4 choices.
Yeah.
And we're only talking about tonight. Expires tomorrow night at 9 p.m.
Okay. I mean, I'm going to stick with what I said. Long Alphabet, short Tesla.
Tricky one. Right, so Phil's going to be tapping away like a madman. We're going to look at Puma because Neil Brewster has requested that we look there. Now, let me
have a look at Puma.
Just have to get back onto the right platform. And yeah, what's your thoughts on Puma as a shoe?
As a shoe, I remember having. I haven't wore a Puma shoe in a very long time, but I remember having Puma as a kid.
Yeah.
I had some orange Puma football boots with white writing saying Puma on that. I must have been like 13, 14.
Were you good at football?
I was okay. Nothing special. But if we're talking about football boots, my favourite is Nike Mercurials. Like I used to wear them even as a kid on like non-uniform day. The Astros, obviously.
I was going to say, yeah,
the Astros. Yeah.
Very cool.
Yeah.
Puma I saw you more as a chess player.
Chess player.
Like school chess club rather than football.
No, I like sport mainly, like football, running, table tennis. I like sport. Yeah, I'm not with board games apart from Connect 4 because I used to play with my granddad.
Is that your?
Yeah, I like Connect 4. Yeah.
I used to play Connect 4 and drafts. And
oh yeah, I played that with my granddad as well.
Yeah.
Yeah.
And who won?
I think my granddad let me win. I was young.
Ah. Good memories, though. Good memories. My granddad was too busy taking me into the bookies to put bets on horse racing. And hence why I am where I am. Good stuff. Right, Puma, there it is. It's been terrible. You've had 2 big warnings that have taken you down from $46 a share, now sitting at 23. What's next for Puma? It's do or die here?
Could you say, obviously Puma's quite a long-standing brand like Nike, Adidas, and now you've got like Lululemon and is it Hoka? Is that how you pronounce it?
Well, that's the thing. So Hoka and On Running, you know, you've really you've got to stop looking at Puma for shoes now, because nobody's going to buy them, right? There's too many. Too much competition in that kind of shoe, and Adidas has murdered them. Yeah, now, can they go down the clothing route And can they change themselves up? For me, it's a dead brand.
Yeah, I do remember when I was younger that they were popular. I don't know too much about on the fundamental side about Puma, but I do think, with as an example, on cloud, Lululemon, that is much more difficult for them. I don't know about their presence in developing markets such as Asia, which I think going forward is very, very important, due to the fact that you've got the emergence of the middle class there.
Yeah.
And it's a very, very important market, which I believe Nike are struggling in Asia as well because of the exact same reason.
I think, yeah, and Neil, you're rightly saying the 1 billion Man City deal, that's, to me, that's the sort of desperation that we saw from Under Armour. When Under Armour were paying out everything, it's like you're kind of shit or bust.
I didn't hear about Under Armour. Did they do a similar thing, or?
Yeah, Under Armour were, I guess it was back in the early sort of 2012. They went big and they signed up every big athlete around the world, which was wonderful for about 2 years. Yeah. And then their margins just got, the margins were terrible, but it was all about future growth because they had grown the brand. Yeah. I don't know if Puma can recover this. Neil, I understand your point absolutely that, this could be the start of something and it could get people back into to Puma, but since Usain Bolt stopped running, then this has been a dead brand.
Also, we've got a comment from Luke Moore there just now. Long alphabet for me. Their cloud being used by OpenAI and Anthropic. Interesting.
TPU's the new chips on the block, plus Waymo auto miles at an all-time high. Yeah, I've got to admit, out of the big five, Alphabet's the one that I am long of. Meta wouldn't have a position.
Too risky.
I think Microsoft was last quarter's winner, and that has performed. Nvidia, I'm sure.
Tesla would be a no-no. That would definitely not. I definitely would not be long Tesla.
Well, let's see how will that. You're definitely in the lead at the moment. The long Alphabet, short Tesla is very much
69%
at the lead. Short both has only got 1 vote.
Okay.
That's the brave one. I'm not sure it's intelligent, but the brave one is to say that Google has performed so strong into this that it's...
You could get the case like we got yesterday, where a few of the firms actually reported half decent results, but share price came off.
Yeah,
so we'll see, because that can happen quite often.
Good. Right, it is 8:30. We got Mr. Beecham, sir.
Charting crypto.
Waiting in the wings, that's right. And then stick around because we've got Dylan Rattigan coming up. Yeah, he's going to be talking. He knows all about the luxury shoe deal because he's got one of his own. A wonderful brand called Euphoria. So yeah, stick with us and give us a like on the thumbs up at the bottom if you like Mini Cooper's hair and you want to have a game of Connect 4 against him at one of our future days, because they're going online now, aren't they?
Sorry?
They're going online now. Your
Connect 4?
Your days. Sorry, I jumped. That's my fault. Your special days that you organise, that you do such a great job over.
From September, yeah.
Yeah. And your workshops.
Yes.
That's the one.
Yes.
But absolute commendable what you've done there.
Thank you, Rich.
How many have you done in total?
6 so far, and then from September, and we've got September, October, and November, and Axe will be hosting 2 and Chris 1.
Yeah. So nearly 100 clients Mini Cooper has organised to come in and then full days.
Full days, yeah. Full days. Yeah.
Absolutely brilliant. Well
Thank you, Rich. And subscribe if you haven't already.
See you in 2.
Okay, guys, before I teach you how to use this, I have to teach you how to use this, the mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Bring me the next shiny new thing. Bring me the next shiny new thing.
We're watching a crisis unfold in the UK and we need to take bold action. Our stock market, once the envy of the world, is in a dangerous downward spiral. At the same time, the UK is stuck in a damaging savings-first mindset with far too few people investing to build wealth for the long term. With our Save Our Stock Market campaign, we're calling on the government to deliver the urgent policy changes our stock market badly needs, from scrapping stamp duty on UK shares to encouraging a shift away from stagnant cash savings and using incentives rather than penalties to get people backing British firms. And to show we're putting our money where our mouth is, we'll be offering every new customer who joins IG across July and August a free UK share bundle. For too long, policymakers have been paralysed by the desire to keep everyone happy. But the time for working groups is over. This is about getting more Brits investing while saving a strategic national asset before it's too late. You can read more about IG's SOS campaign and free UK share offer on our website.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Good morning and welcome to Charting Crypto with me, Chris Beecham, or as Anthony might say, with I, Chris Beecham. Axel is still on holiday, so you get me again, and let's hope the internet works this time, unlike those of you who are watching Charting on Monday. So we think we've solved the problem. The people responsible have been sorted out. Let's go to Bitcoin, which for a change is not sitting at a new record high in early trading, but nonetheless still looking very, very solid indeed. We've probably got what looks like at this point in time consolidation. Having seen a record high more than a week ago, gosh, Bitcoin really has fallen asleep. It's been more than a week since the last record high, up at 123. Unsurprisingly, it hasn't yet been able to carry on through that. Interesting that you've got a very risk-on morning for equities following that Japan trade deal, and yet not so much for crypto. A bit of a divergence there for a change. What we've seen over the last, really the year or so, has been the way that Bitcoin has become more and more of a risk-on asset, but also something of a hedge against uncertainty. But it isn't, it's like the parrot, it's not dead, it's just resting. And we are essentially seeing a bit of short-term weakness coming in this morning, a bit of profit taking after, of course, what was a very strong day yesterday we saw Bitcoin finally rally off 116 and make a move to the upside. Although, as you can see, the sellers for the time being are still coming in around the 120 level. Big round numbers always provide an attraction even in these crypto markets. So for the time being, looking at the way, yes, we will get to Solana, Jugger, don't worry, all in due time, 120 here. If you're looking at something like stochastics providing with a momentum indicator, that has started to drift down, which is a bit of a concern in the short term, but nonetheless, the buyers really reasserting control here, at least in this time frame. If we flip over towards perhaps the hourly chart, we'll get a sense of what's been going on overnight. And you can see there these long wicks, quite a lot of buying since Sunday night, around, as I say, above that 116 level, 116,800, providing some short-term support. So a little bit of a pullback overnight, really. Those Japan headlines really not doing much for Bitcoin, interestingly. Just a bit of weakness coming through. Notably, we're back below Monday's intraday highs. That's also a sign that maybe we've got some more consolidation due here. But overall, of course, the longer term view, if we perhaps go to the other end of the spectrum, take us onto the weekly chart, that of course is an uptrend by any other means, and still very, very strong, building on this rally from those April lows down at 80,000. So just like stocks, of course, a very impressive performance for Bitcoin. And we expect to really, with crypto week, might be done in the US, but overall the trend remains staunchly to the upside. Looking at this 50-day moving average as well, hovering in the background, providing possible support in the event of a pullback, but it's very hard to imagine that one is about to develop in the shorter term. So that's your Bitcoin outlook. Looking here, we're going over to Ethereum, an even stronger performance from them, really looking down to 3,800 on Bitcoin, on Ethereum, sorry, remember the one we're talking about. Looking though, if it's looking at this now, you'd say that is probably quite a bit overextended, certainly from the 50-day moving average. That might lead you to be a bit more cautious around this one at these levels. If you're looking for a similar example of that, the May rally, the early May rally from about the 7th of May took us up to 2,700 on Ethereum, and then essentially we had to spend the next nigh on 2 months consolidating sideways before we finally got this breakout above 2,800, taking us on towards these new record highs. So yesterday's session, we were able to rally firmly off those lows, not doing so much in order to hold on in the short term in early trading this morning. So it's weakness across the crypto space. You can see really there all these cryptos coming under pressure this morning for the time being, no doubt after a bit of a run. I think that probably it is a case where maybe equities just continue to have the edge for the short term. The fundamental news flow with Japan trade deal puts people in a good mood, hoping no doubt that others will follow suit, most notably of course the European Union, which has been sounding much more aggressive in responding to those US tariffs. But Ethereum really coming back off these highs over the last couple of hours. If we again go to the hourly chart, you can get a sense there. This overnight bounce from about 36.40 up to 37.60. That's really run out of steam. Quite a bit of selling in the short term coming through there. We'll see whether that persists. And if we look at this from on the hourly chart, this area around 36.20, 36.40, definitely providing a potential area of support, hopefully. Notably, of course, this was the highs from last Friday at 36.80. So as well, if we close back below that on this hourly chart, you might argue that what we've got now is the makings of at least a more substantial period of consolidation. Below that, down towards these 3,500 lows from Friday's session. There's plenty of support really coming through all the way back down in the direction of these lows from down to 3,000 on Ethereum. So I wouldn't be too concerned. Really, it would be quite a bit of a pullback there. But the volatility, of course, is a given with cryptocurrencies, particularly, as I say, given how exposed we are from the sort of the distance, the overextension from the 50-day moving average is undoubtedly a bit of a concern in the short term. You see it across so many markets. It's not just a crypto thing. After you get a big move like this, the moving average has to take time to catch up, may in due course provide its own form of support, but at least for the time being, we're just watching to see if we have a bit more weakness coming through, maybe some profit taking coming in. We'll watch to see, as I say before, those previous highs, always the important thing to look for in crypto. So 28.82 or so, the 11th of June high if we do see something a bit more substantial beginning to develop. Interesting question there from Jesse14 to chart global money supply and its relationship to cryptocurrencies. That would be a very interesting one to do. I know there's been a lot of focus on global money supply, M2, of course, one of those indicators that economists love, and the question of whether that's providing a strong tailwind for equities. It probably is doing the same thing for crypto, to be honest with you. But also you've got to be aware, and this is a bugbear of mine if I can briefly step away from crypto. If you chart two things and you chart them on the right y-axes and you get two different y-axes, you can make them look as if they're perfectly correlated. I would always be very aware of these double axis Y charts because you can make anything look correlated if you try hard enough. In fact, if you visit spuriouscorrelations.com, you can have a great couple of hours finding things that are entirely uncorrelated but look correlated. I think there is a justifiable point to be made, Jesse14, about global money supply and how you just have an abundance of money at the moment sloshing around the system and liquidity just providing the fuel for further gains in cryptocurrencies. It's probably something that is far more of a weekly thing, or it's a long-term move rather than looking at it day to day. But certainly if you be worth looking at that, I'm sure you could do it. Maybe something like stockcharts.com might give you the global money supply figures if you don't have access to Reuters terminal or Bloomberg. Just something to bear in mind there. But let's move back to Solana. When my internet decides to play ball. Oh, I think it's gone again, everybody. This is excellent. So I'll just keep talking for the time if I can try and get it back again. I think we're going for cryptocurrencies. I think the galleries probably, I can hear them screaming into their mics at this point. There we go. There we go. I'm going to keep talking for 5 minutes because we can't have this happen twice in a week. Once is unfortunate, twice is careless, as Oscar Wilde said. There we go. Yeah, it's very impressive that it manages to not work when I come in. I think again, it's a possibly deliberate sabotage. You go in. Where's my rescuer? Where's my knight in shining armor? He's going to come and rescue us from the consequences of our own technology. The man himself. This works really well. Oh, you might not be needed. Stand there. Look at this. This is a service for you. Then we've got to make sure this actually works as well. Good. And we're just a bit poised to do Solana as well. Don't get into my shot. You'll spoil it. Wait, we're still reloading. I think we're there, but not quite. Still offline.
Oh, but let's do the poll results.
Do the poll results. What poll results? Oh, okay. So we're going to briefly step away due to technical difficulties. Poll results. Position Alphabet or Tesla for tonight's earnings. Long Alphabet, short Tesla comes through at 64%. Interesting. So sentiment there very much anti-Elon, it has to be said. I'm not keen on that one. Long both at 33% and then short both 2%. So there we go. And with beautiful timing, I think my internet has come back. Poor old Phil is just hovering in the background here like some unbidden assistant. It's brilliant. I'm going to see if I can get Solana up for everybody so that we can at least push on with charting crypto. That's the most important thing here. There we go. We've got a chart. Round of applause, everybody. There we go. Can you all see that? Let me just get it back to full screen. You don't get this with Axel Rudolph, do you? You don't get this. Look at this ability to improv. So back to charting crypto. Solana, of course, seamless. Look at this, how it's pushed on through these May highs. It's really one to watch, the fact that it's managed to close above this 186 level that we saw from the second half of May. Gosh, that did kill a lot of time, didn't it? Technical difficulties always help with that. The next thing to watch is this gap around these levels. We get there in the end. At 221, that was where we saw the last sort of bit of volatility in late January. Now, beyond that, looking to the longer term, if we get a kind of move in Solana that we've seen in the others, then these highs from the 22nd of January really come into play at 264. Not so overstretched from the 50-day moving average in the short term. Overbought on stochastics, but it's usually a sign of very strong momentum. And crucially, no sign of any divergence in terms of momentum. So if you look back to what we had in late April, we did have some weakness coming through around the 150 level, and then it shot higher, but you can see how stochastics weakened, a sort of a warning of what you might get into the June and July period of some weakness. So do watch for a similar pattern recurring on that front, really. for Solana. And then I think if we just move on finally to wind up before my luck runs out. I think my luck runs out again with the technology. There you go. I think we might have to wrap this one up, and then we're going to go and shout at the relevant IT people and ask why it's a sabotage. If we can get Doge up, if it might get, so if we can squeeze in a Dogecoin, which is down 4% in early trading this morning, so that's a bit of a tough time. It's connected. We might be able to get Doge in. No answer. Computer says no. But sorry once again, everybody. We'll do our best for next time. It has come back. We're back. Do you want to should we get through one more? One more Doge. Where are we on Dogecoin? Let's not leave things out of the situation. So we're down here at 25 cents was the previous highs from the middle of May. We're really not going to push our luck with another one at this stage. But the fact we had a new high here, higher high in stochastics, takes a very, very solid outlook on this one, down from those lows around 14p. Which was big support, really. And this is the great thing about crypto, support really, and resistance really come into play for this one around this sort of March low of 14 cents, and how perfectly worked in on the 22nd of July. We'll now see, crucially, whether we can hold just around these levels from the middle of May. And if it can hold on to that, that would be taken as a relatively bullish sign for that. So thank you for bearing with us on what has been another joyous technical issue filled Charting Crypto. We'll try so much harder to do this next time. And we'll thank you very much, and we'll see you again next week for Charting Crypto.
In the last video, we talked about how the S&P 500 has a higher PE ratio than the FTSE 100 because investors expect faster earnings growth. But let's look at what happens when those earnings actually grow and why that makes such a big difference. Here's the S&P 500 in year one. Its PE ratio is 24 times, which means investors are paying 24 times the earnings to buy shares. This tower represents the share price. The height of each block reflects the unit of earnings needed to support that valuation. Now, let's jump forward to year two. The share price hasn't changed. This tower is exactly the same height, but look what's happened to the earnings. Each of these larger blocks represents higher earnings compared with the smaller ones from year one. Because the earnings have grown 50%, what used to be 24 times earnings in year one is now only 16 times earnings in year two. That's a huge improvement in valuation, even though the share prices have stayed the same. This is the power of earnings growth. When companies deliver stronger earnings, the PE ratio naturally comes down, making the stock look cheaper, even if the share price hasn't changed. And when investors see that kind of growth, they're more likely to stay invested or even buy more shares. And that's what pushes the PE ratio back up. And that's what makes shares go up or down. Now compare that to the FTSE 100, where earnings grow more slowly. Even if the share price stays the same, the PE ratio doesn't improve as dramatically because the earnings aren't growing as fast. That's why growth is such a critical factor in investing. It's what drives long-term value. So here's the big lesson. Earnings growth doesn't just boost a company's value. It makes the stock more attractive by improving its valuation over time. As an investor, the holy grail is to find companies that can grow their earnings by more and for longer than other investors may already expect. This may even mean avoiding shares that are already very popular, over-owned, and potentially overvalued. Because if a stock on a very high PE ratio misses its earnings estimates, then the price can come crashing down.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat. Come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Hey, trader friends, welcome back, and we are counting down to the opening bell. Richie Rich, how do we do this? We color match without even talking to each other. It's incredible.
So you got Dylan coming up this morning?
I do. He's going to tell us which side on the fence he is on, trader friends, because earlier we had this poll, right? Are you kind of sat there thinking this grind up is going to continue? There's not anything to worry about right now. Or are you on the other side of the fence, like Richie Rich is, waiting for that correction? Joachim also waiting for that 5 to 15% correction very soon in August. We've also got the results for the Alphabet and Tesla poll out.
Right, so 64% of you agree with Mini Cooper to be long Alphabet and short Tesla. 33% of you think long both. And nobody wants a long Tesla, short Alphabet. Whoa. I tell you what's the punishment now? If that's exactly what happens. Because now we've seen it, right? The market is the market. So therefore, there should not be the chance that absolutely nobody thinks that one combination won't happen. The anti-consensus view would be to put that exact trade on.
The punishment should be to spend a day playing Connect 4. Against Mini Cooper. That would be the punishment. Yeah. The other poll was a bit more sort of market-like, wasn't it? It was almost a 50-50. That's a functioning market, people.
But it's particularly concerning that absolutely nobody thinks that it's possible
that is concerning.
To be positioned that way.
Yeah.
So, yeah, I think I might buy some upside in Tesla on the two-day trade on that.
I am on the short Tesla, long Alphabet, just because I think Tesla can't possibly say anything that is going to lift it after the robotaxi issues, and also the humanoid story or the next cult phase is just too far away,
But
right? It will come.
Isn't this the whole history of Tesla? That everybody always expects it to go down. It's too expensive. Elon's an idiot. Not an idiot. He is a dislikable person in some of the things he says and does. And therefore, people want to bet against Tesla. Well, what happens when you are in that situation? So shall we look at some calls for Friday expiry, right? We're there at 330-ish at the moment, is that right? Stock closed at 332 and it's on a IV rank of 17.5. So if we were to say that this thing could go up 7%, which is the expected move, that would take us to 340. 340 calls for Friday would cost us $8.75. And Tesla's not going to go up 15%, right?
No.
So that would be 380.
Yeah.
So, it's no way. 37, we're long at 340. So let's get short at 370 times 2. So double the size.
Wow.
So I'm going to do that one. The short call in double the size. That takes us down to, we've still got to pay $5 for that.
Yeah, the thing with Tesla is expensive, right? Because of the amount of volatility as well.
Yeah.
I would almost treat this like what Piers was saying yesterday, Soundhound. You know, you always buy the dip after the earnings if there's a dip, because, you know, there are lots of bag holders, right? Lots of people who get to certain levels or algos and then you see it drop again. We've seen this consistently. It's been in this channel since around May this year. And so if we see earnings disappoint and the shares go down, that is a signal to buy, is my humble opinion.
Right, I've had a little play with it there. 345, 365, 1 by 2. A 345, 365, that's only $2. I could play with that. And then, you know, you could potentially sell a 300 put, but no, is it going to be down 15%?
No.
No.
No. Normally, let's look at the
a little bit
ATR
dangerous,
here. Let's take a look at the ATR, changing that to 14
Yeah,
there.
tell me where it's safe.
Look, it's at about, call it 15 there, 14.53. So, and take a look at that. It's been coming down, right? It's been coming down. So 15% I don't think is going to be possible. I mean, it's not realistic.
Okay, well, I don't think I would do this because it is quite risky, but if we were to sell a 300 put, remembering they closed at 332, so it's actually only down a 10% move. So let's sell the 295s. That takes us down to 74 cents for $20 of upside in Tesla. And you get hit. Yeah, that was Pete Ward. So yeah, there's our trade for the day on Tesla, only because none of you want to be long Tesla, short Alphabet.
Yay! Here we go. All sessions, count me down.
Oh.
This was Pete Ward, by the way. It wasn't me. It wasn't me that broke this. Just letting you know. Right, we're off to the races. Let's have a look. Yeah, so let's zoom in once I press that for you. And taking a look at the winners list there, we've got Beyond Meat right at the top there. That is very, very volatile. The Novo Nordisk, that's up 2.5%. And NEO up 1% there as well. Taiwan Semiconductor also gaining ground. And we have Block. Is that you are Saxena that was looking at Block earlier this week, up 0.8% there. Crossing over to the losers list, Rich.
Well, it is GM and Ford. GM and Ford down on the back of that Japanese deal. GM down 90 basis points, Ford down 30 basis points. But that's the only real losers in my list this morning.
Yeah, Lucid also following Ford lower, down 0.33%, and a lot of the crypto related names also on the losers list. Monkey Man, if you're watching as you're doing your downward dog, hims and hers is down 0.1%.
So what's Monkey Man watches on his television now?
Yes, he does his yoga exercises before our show and during our show as well, because there are at some points when he can't move several positions because he's in a position. So, yeah, there was a lot of talk as to whether he was doing the downward dog and having the mobile phone under him.
But there must be a monkey yoga position, isn't there? If there's a dog.
I don't know. That's a good point. There's a happy baby.
A happy baby.
There's a crab. There's a there's a lotus, isn't there? But I'm not sure about a monkey. Good point.
There is now.
Tesla, taking a look at that ahead of the earnings, up 0.33% there. Also checking in on the big mega caps that are going to kickstart our week. Intel, all sessions there, up almost 1%.
That's right. So Thursday night, while I am on that aeroplane to the Balearic Islands, is Intel going to break that $24 level on the upside. That's certainly going to be the first thing I check when I get off the plane.
Have you put a position on?
Intel, I'm long Intel, yeah.
Nice.
Yeah.
Yeah, I think it's new chief executive. I know you like your CEOs and you watch management really closely. Li Butan is going to provide a really good conference call, and the company Intel has had major restructuring, and he's going to try and bring them back to basics.
Yeah.
Yeah, back to the core. So we'll
Tricky
see.
one though. I'm only long through a call spread.
Can I quickly look at something for, I think it's Kate Murphy. Is it Kate? Or is it Kate with calls? Look at that.
Oh dear.
Or was it Jugger?
I don't like the retracement on that.
I know, right? But earlier, or last night even, this is the daily chart, people. Coles had a big move, and I think it was, no, Jessie 14, that's right. Jessie 14 was the one that said that she went into Coles and came out and did very, very well. Something like double the returns. Key levels to watch out for, Jessie 14, if you are still watching resistance at around 21.23 and also 29. And we have punched, well, we tried to, but it's now down and might fall in the main open. But make sure, Jessie 14, if you're watching, yeah.
There she is.
Make sure you put your gloves on, right? Get gloves on, because this is very much considered a meme stock now, right? And so, yes, there is this turnaround potential. There's been talk of this short squeeze, extremely high short interest on this, but please just be aware that it is now being considered as one of those meme stocks.
Right, we'll just update you on the UK. So going over to my screen, you'll see there is very much the algorithms are at work. They are selling your defensive names in the FTSE today. That's right, SSE down 2. Then you've got the utilities, Centrica, National Grid, Severn Trent. You've got Vodafone down 1% before numbers tomorrow morning. You've got British American Tobacco and Imperial Brands. This is nothing single stock related. This is the algorithms at work to sell the defensives. The banks are unchanged. And on the upside, Wetherspoons has turned round. Wow. So that's gone from down 3 to up 3.5. And then we've got Farmers. Look at AstraZeneca go up 2.7. And we've got GSK up 1.5. And then, yeah, some of the hotels, IHG up 1.4.
Go Diageo!
And Diageo, yeah.
Up 1.2%. Not. It's going to have to go very much higher to get to where I bought it. So turning to Germany, we talked about Porsche and the
How are
cars.
those autos doing?
They're doing very well. Look, Porsche up 7%. We've also got Volkswagen up 5.2%. Zooming in for BMW, also going vroom, 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 up 4.3% there. We have SAP down, though, 2.7%. I think SAP was out with numbers earlier.
That's right, yeah. SAP adding to the woes of European tech.
Yeah.
SAP down 2.7. Has ASML recovered any from yesterday's shocker?
Oof. Have a look. SAP, cloud growth falling short despite maintaining its forecast. Also, just taking a look elsewhere, Continental is also up 2.3%.
Right, taking you on to some of the Frenchies. Renault also up 3.3. Kering, LVMH, we're seeing strong on the day as well. So they are loving the tariff reports, the tariff deal with Japan. And then on the downside, what have we got? We've got Adidas down 1.4. That's interesting. Adidas down, but JD Sports up. What's going on there?
JD Sports seems to, and Andrew McKelvey, if you are here, because you and I watch the same stuff, JD Sports has statistically risen more in reaction to your favorite stock, one of your favorites.
Yeah.
Nike.
Which has been upgraded today, that you put on the chat earlier.
Yeah, Nike's been upgraded. So, yeah.
Bit of a catch up. They've gone from a 58 target to 74 target. Yeah, that's where the stock is, yeah.
Yeah, these analysts have to do something else. So it looks like an egg on their faces, right? Roche Holding up 1.5% there. Those of you that trade this space, that's because the upward movement there may be because there was not as much consternation over the pause in gene therapy shipments outside of the US.
Good. Right, I think that is us.
Yeah.
Off to pack my suitcase, Ange.
I saw him packing glow sticks earlier.
No, we have tattoos. fake tattoos that last for 3 days.
Nice.
Well, you hope they do, otherwise I might still have a tattoo.
Have you cut out your little turtle?
My little turtle?
Yeah.
What's that?
So, when your mates are passed out or sunbathing and they're faced that way or they've gone to sleep, you cut out a little turtle and you put it on the back.
Right.
So that they get a little bit that's not sunburnt.
I could think of other things
Yeah.
we could
Or
put on.
I chose turtle because the other word would be beep by producer Phil.
Good. So, yeah, I will be off for the next few days, but back on Tuesday. Yeah. Angeline, you are off next week as well.
I am, but whilst you're off, so much on. Are you sure you don't want to join from the beach? Because we, of course, have Tesla, Alphabet. See, I'm trying to reel him in. He's not. Look, help me out, guys. IBM, all these big stocks, out, and then of course next week is going to be a flood of earnings.
Yeah, and just watch. We've got the podcast we're recording tomorrow. I'm recording the podcast before I'm off to the airport. We're doing a Bond special. That's right. So the name is Bond, and it will be Poppy Bond, taking us through one of the country's
Spice Bond.
Bond experts. No, it's Chris that is the Bond expert.
Okay.
Spice is the equities expert. So, yeah.
Arsax is right. You won't be with us for the Vodafone earnings.
I know. I'll be on the chat, don't you worry. I'll be in the chat tomorrow morning.
Yeah. Producer Phil, is he calling in from the beach or?
There you go. Gavin Ackers, reach for the lasers at Cafe Mambo.
Ah, Gavin.
Gavin knows our itinerary.
You clubber, you.
Right, so yeah, we got a Bond special that's released on Friday afternoon. If you ever wanted to know about bonds, then this is the podcast that you can listen to. The Art of Investing Bond special on Friday afternoon.
Do hit the like and subscribe button, especially if you want Rich to call in from the beach. And also, don't forget, don't be a silent listener, trader friends. Do not be, I know there are about 50% of you because I met a load of you. Do get in on the chat because the more you put in, the more you get out from Rich and myself. So, you know what to do.
If you're looking for flexible ways to trade financial markets, whether you're experienced or new to trading, you've come to the right place. CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising and falling prices across 17,000 markets, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going to go down, you sell. When trading CFDs, you're trading on leverage. Now, leverage lets you trade bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also amplified. So be sure to manage your risk. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade CFDs with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
me the next shiny new thing. Bring me the next shiny new thing.
Okay, guys, before I teach you how to use this, I have to teach you how to use this. The mind. The cash return wasn't all about speed, it wasn't always about power, it was about the mind. Become the bull. Visualize greatness. Okay, minds are ready. Time to go. Hey, come on, Pat, come on. Cash returns, come on. Oi! Oh, you're not going to get better than cash returns.
Hey, we have Trader Friends, Dylan, all the way from the sunny Riviera. I loved you ribbing Rich earlier. You know, unlike some people, you dial in wherever you are, wherever you are.
That could be, you know, listen, time doesn't even actually exist, first of all. Time is an invention of man. Because the only thing that ever exists is the present tense. There is no future, there is no past, there's only the now. And so if the now is the time when I'm talking to you, then that's where I'll be, whether it's from, you know, some people might say, oh, well, it's 4 a.m. in New York, but is it really 4 a.m. or is it just right now and I'm just talking to Ange?
Or is
you know, right now I happen to be, now I'm a couple time zones ahead of you at the moment, quite honestly. And now I've flipped, I've done a little leapfrog. I was behind you, now I'm in front of you. But if you can get distracted with these things.
You can.
All I think about is, am I talking to Ange?
Ah.
And if it's time to do it, then I show up whatever time it might be. It's right now.
Ange was really impressed that you dialed in from New York or New Jersey, because you're such a well-traveled man. Because I've been on those time zones, and you were up at like 4 a.m. I think 5 a.m. So I completely
I was just living in
that.
the now.
In the now.
I was just living in the now.
Speaking of the now, our trader friends all have been doing polls this morning, and like every good functioning market, it was good to see that we have a very healthy, 50% there. Some on the side of, we're going to see this grind up continue. Nothing's going to stop me now, at least for some time. Then there's the other camp, which is what you call the, call your mom. Where do you sit? Are we going to have a 5 to 10% correction in the next few weeks?
I mean, first and foremost, I have no idea. Let me be very clear. With that said, here's what I'm hoping for. What's today's date? The 23rd? July 23rd, I do believe.
Mm-hmm.
If you were to believe the American president, there's going to be a whole new set of tariffs on August 1st.
Yeah, that's right.
Now, of course, no one believes the American president, which is a different issue. But what I'm hoping for is that we get a bit of a tariff spookorama, a little spook job over the next week. I'm not going to get short because I just don't have enough confidence in the whole thing. I'm kind of just leaving things how they are, although I've got this long dollar position on, which is the bane of my existence,
Yeah,
but I won't talk about it.
We leave that to Rich, that short thing.
Leave that to Rich and my mom. But I think that the opportunity that I'm hoping for and that I'm anticipating and that I think is the most likely is I do think you're going to get a bit of a tariff spook. It won't surprise me if you get a bit of a sell-off. I think even the most recent dollar weakness is part of that, and I think you buy it. I think you the same way you like I talk frequently about selling oil when it's on the World War III spikes. I do think that when you get sell-offs on tariffs, you buy them. And I believe we're coming up on a situation where the probability of that is obviously going up just because of the way the calendar is set up. Now, with that said, it's a little bit more squirrely because I'm pretty optimistic for the tech earnings. So what the Google report and Tesla and all this, and so I think that actually could mitigate. In other words, I think the reason you might not get as much of a sell-off as you might for the tariffs could be sort of because it's in the mix with these tech earnings, which I think are going to be more good than bad.
So yeah, that's a really interesting point because I think the earnings will be more good than bad as well. And what's also key is that, like you, I'm kind of like, you know, Trump has done this taco rollback thing so many times, right? So I don't want to get burnt by if things don't go the right way. So I'm not going to short this time around.
Yeah.
But I do think that any dip is a buying opportunity. And so my stance is, Andrew's got cash on the sidelines, and I'm kind of drinking copious amounts of coffee going, are we there yet? I'm ready. Are we there yet? In the meantime...
But this is looking for a way to get long, you're saying. You're sort of biding your time to get long without the confidence to get short, which is kind of where I'm at.
Exactly. So we're on the same page. And in the meantime, those things that I'm kind of looking and thinking, I can't stay out for very much longer. I need to kind of build a position here. So like in the gold space, right? You've heard me talk about this many times, looking to build a position, not just in gold producers, but gold itself as well. I'm kind of like dollar averaging in because I kind of like, you know, I can't wait much longer. I just need to do it, otherwise I'm going to lose momentum. Trader friends, tell us what you guys are doing over there. Jugger, morning to you. I see you are in number 2. Jesse 14 has beaten you. You are in pole position along with Andrew McKelvey as well. Andrew, my Sarabi gold not doing too well despite the gold price. What is happening there? Fill me in, please. And call me Walter. Good morning to you. Just chiming in as well. Now, the key thing that I need to be devil's advocate as well, Dylan, and I'm sure you watch this space like a hawk, is that PEs for, you know, companies in the US as well, they have been, you know, doing really, really well. But the issue is looking at forwards, the better we get on this front, just throwing up my slide here that I've crunched data for you. You know, the better they get, the higher that E, which means that we are going to start being in a situation where it's going to be increasingly harder for the S&P, historically anyway, to keep moving higher. Do you agree with this premise?
You're saying just because you're saying at 22 times forward earnings, we're at the upper end of the earnings multiple on the S&P.
Yeah. Do you agree with this, or do you think it's poppycock?
No, I do. I mean, I think
we're new space now, new
I think
era.
it is a very I think it's a very relevant consideration. I think you have to sort of always be cautious about any forecast related to earnings, right? And so the underlying piece of that multiple is the presumption that the forecasted earnings of the next 12 months is accurate or accurate-ish. And I actually think, I mean, that's not necessarily a reason to sort of, I actually think there's a possibility the earnings are not as good. I guess what I'm getting at is I think I could make a case that multiple is more like 23 or 24, because I don't think that the tariffs, for instance, or inflation, both of which are real things, even if I'm dismissive of the tariffs do exist. They exist, hopefully in relative moderation, but they do exist. And inflation exists, 100% exists as of June. And so I actually think you could make the case that multiple is more like a 23.5, that it's even more stretched than your number suggests.
Yeah.
I mean, Chris Vecchio and I were going through this last night on Overtime, and Chris is very optimistic, historically bullish the last couple of years, blah, blah, blah. And I've never seen him more cautious, to be honest. I mean, like if you want to talk if you've ever wanted to talk yourself into a short position, not to sort of betray the earlier part of our conversation,
but
Chris. to get in with our trader friends here, like if you're, you know, between the seasonality, the multiple, the tariffs, all the good news is sort of baked into the cake. You know, if you were a brazen and audacious lad or lass, you could get yourself into a dandy little short position for August, or at the very least, think of it as a insurance policy.
Yeah.
You know, I mean, Chris and I were talking last night about what's the difference between a speculative position and an insurance policy, and we agreed, obviously, that a speculative position is a tighter strike on the in the money side, basically just under, and a bigger position, so tighter and bigger. Whereas insurance policy has a little bit more room under the strike and is a little bit smaller policy. And we for sure agreed that if there was a time that it's worth picking up some ES puts, even on the insurance side, right, 5% lower, modest position. That does make sense, and you just gave more of evidence thereof with your multiple data. And then if you're feeling a bit more audacious, you can wind it up and bring it up, 2% or even at the money.
Yeah.
And hope it and believe in the future of stock market declines in August.
Yeah,
so
yeah.
I'm not ready to do it yet. But
I'm not either, and I'll tell you for why. There are two reasons, trader friends. Caught short, they're saying same as you, and hold your nerve. Yeah, I'm biting on a stick here, kind of like drinking coffee, wondering, how long is this going to take? There are two reasons caught out, and other trader friends who have a similar view to yourself and myself, Dylan. And one of them is because, look, I'm showing you the options ladder. I'm going to go further out even, 25th of July. And what you can see here, this is the contract for the 25th of July, is that in terms of volatility, it is still crushed, right? Still very, very low there. And then pushing it out to the 31st of July, still around that 12 handle, and 29th of August, still 13. Now, come off my screen, Dylan, the second reason why I'm holding my nerve but not going short is because we have all this mood music coming out from the Fed, right, between JP and Trump, and it looks like it's kind of gone away now. But what essentially is true is the market, largely, in my humble opinion, are looking at lower rates to come, right? No matter which way you cut it, the next Fed chief, the expectation is there's going to be lower rates to come. I think the last readout I saw of a couple of data points from LSEG, they have a good bunch of people there that crunch interest rate futures, still looking at 96% probability of 2 rate cuts by the end of this year, and that will cut borrowing costs and support valuations. Whenever we hear of these probabilities not ease off, that can only be supportive of equities and continue to be supportive.
I mean, I agree, but I think that's why all the trader friends are quite at odds, and I think that's why we have a very robust market going both ways right now, because quite honestly, you can choose whatever perspective. I can choose any perspective right now and give you 3 to 5 citations or references that are super credible and persuade you one way or the other. And so, it's sort of a pain in the neck, actually. But it's also, this is where, money goes to be made or to lost, I suppose. And it's why I'm pretty cautious. The thing with being short for me is I've so little success over time being right on the timing that I find that just sort of waiting for an entry point on a dip, I like hoping for a tariff sell-off and then hoping to buy that, for me personally has just been a more reliable, a more successful way to relate to trading than to try to pick a spot as to when it's going to go lower. I mean, I haven't had success to it.
Well, that's why I like dollar averaging.
Just because of timing. Yeah, exactly.
Exactly. And unless you've got like all the time in the world to sit in front of your laptop or, be in front of your mobile phone, then, it's hard to call a top and a bottom. Speaking of top and bottom, we also had another poll from our trader friends earlier today. Phil, if you can get that up, producer Phil, whether you thought due to the earnings this week, one should go long Tesla and short Alphabet, or short Tesla and long Alphabet, or long both or short both. What's your call? I am very much in the short Tesla, long Alphabet camp.
I'm long Alphabet, long Tesla. I like them both. Love them. Love them both.
There you go, guys. You heard it here
Really
first.
like 'em.
Long both. Yeah, I know you on Tesla. It's a longer term play for you. But you think the earnings are going to be good despite all of the...
No. I don't. I think the earnings are going to be terrible.
Oh,
but I
then
think
you have to
everybody
be
knows
sure
that.
because this is based on the earnings.
I don't care. I think the earnings would be bad. Listen, the last quarter was the worst quarter in the history of Tesla. The stock went up. I think everybody knows that with the situation, and they're just waiting for the rotten, stinking half-life of Musk's political adventures to wear off. And once you get the second quarter behind them, then now they're probably 50% down on the half-life, and now you can start to bring it around the horn. You know, I think that my point is, I think that the lousy numbers are in the stock. I think that really it's more about just rotting out the time, such that people can forget the stink, and then we'll come back to the fancy cars and the transportation tech and the future of the world, which I think was right around the corner.
Right. So you think it's been baked in, so no matter what the results are, it's going to ride higher.
Exactly. I mean, I think this quarter is going to be a duplicate of the last quarter. The numbers in the last quarter were horrifying. Stock went up.
Right. In the immediate aftermath, I'm feeling it's going to go down, right after the earnings. But you know, who knows? It might climb back up by the end of the session. We've seen that before. Some of the key challenges for Tesla, of course, the automotive sales falling 8% year on year, and also it's had intense delivery pressure and rising competition as well from its Chinese counterparts here in Europe. And also lots and lots of cult followers of Tesla. I know Tom Sosnoff sold his sometime last year, but I have still many friends out there that own Teslas, and they're all kind of saying, great car, but in need of a refresh now. So looking out for any comments on that, and of course the outlook, and also comments on the humanoid as well. Alphabet, let's have a look at that. We had Luke Moore here earlier, Dylan, saying that out of the three, he was most keen on Alphabet. So, key expectations there. Rise in revenues expected. Also, the consensus outlook at the moment, 39 out of 50 analysts rating Google as a strong buy with an average price target of 202. Your thoughts on Google? I know you like Google and Alphabet, rather.
I mean, I just look at Google as an AI. I mean, Google is the data king of the world, and at one of the whatever 3 or 4 super credible contenders in the land of AI. AI is here. AI is now. AI is the future. Meta, Microsoft, Google, OpenAI, and then maybe Musk, but you know, maximum there's sort of 5 people in the game. Apple should be in the game. They're not. Shame on them, but Google for sure is in the game, and it's a good game to be in. And I think it'll be good for the. I think they're going to have a lot of nice things to say coming out of their earnings. I think that the interesting thing is, you know, I think Google search is done. So there'd be a world where you would say, oh well, hang on, Google's in the weeds because you know Google search is over. But because Google's not ultimately a search business, as we know, it's a data business at the end of the day. I think they're well positioned to just make the move over, even though personally now I use GPT. Instead of I don't do Google searches anymore. I use the GPT. But I'm imagining that Google is, you know, obviously Google is not Eastman Kodak with digital, refusing to do digital film. And so I feel I have more confidence in Google not only making the transition into the AI world and the post sort of old school search and link world and into the world, in not only making the transition, but exploiting it to their great advantage. And I think this quarter will reflect that.
Yeah. The interesting thing, and you hit the nail on the head, is that, you know, people think that, you know, Alphabet is all about Google. I think it's more now about data and how they manage the data for, all manner of businesses, right? As we've seen, and it's
100%.
going to move away from this, trader friends, because don't have to look too far. Just look at our chat, look at our Discord, and look at what Dylan's talking about as well. Loads of us already use Gemini, we use Llama, I use Perplexity, I use Claude to write my script when I'm looking to enhance my trading strategies. But at some point, all this crunching, AI crunching, which I call it, right? It's going to need a lot of processing power, and Alphabet will be there to provide all this crunching, muscle, whether it be processing, whether it's storage, and that
also
is
the training data. I mean, the thing is, he or she who has the biggest data training set wins. Also, is another piece of this. It's another reason why I like Meta, because I just feel like Meta has a really great data system from a training perspective.
Yeah, and that's especially true if you do a lot of analysis on facial recognition as well. So have you heard of the triangulation payment system, Dylan? I need to
No,
try
I
that
have
with
not.
you sometime and try and get your face to pay my bills. So with the data set, trader friends, that obviously Meta has, ka-ching! Dylan's looking very worried here. And
What do you mean you're gonna?
I can go to Milan, right? And then I'll be out with you, and then I'm kind of like paying. And so let's say we've the triangulation payment device and payment systems set up between you and I and maybe producer Phil. And I say, hey, I want a super expensive gelato or one of those big Prosecco's.
You want a diamond-plated pistachio gelato?
Yeah, I do, actually. I do.
Okay.
So what
Okay.
happens? I
Okay.
then I look at you, Dylan, and I go, well, but I didn't bring my wallet. I didn't bring my Apple Watch, which I pay with. But no one's in this special time of the triangulation payment system. No one's actually. You're not swiping something. Essentially, the cashier is swiping or taking a photo of your face. Now they say, no problem, we've got your diamond crusted gelato, right? All we need to do is, if your mates trust you, Dylan and producer Phil, we're gonna get them to look at the cashier's camera. And just by knowing that you're there with me, it triangulates to go, yeah, these people are always with her. They're always with her every single day. So if they say yes, put the payment through.
So so basically, it's like a third party. It's an inferred third party reference as to your credibility to pay.
Absolutely, absolutely. And I've already checked out these systems. They are being tested in places like China, and apparently it works. I mean, there is authentication, but they find other ways, right? So it's like my thumbprint or whatever. But for those of you trading tech, do look this up. It's not hard to find. Google it. Google triangulation. You'll find it. And payment systems, or do it on ChatGPT. I'm sure it'll then track you. Dylan, call your mom.
Why does your lower third say MSTA?
Because because IG paid for me to do this very, very tricky exam, and I got through level 1 and level 2. Which means that I am a member of the Society of Technical Analysts.
Wow! Wow!
But I'm very shy about it, so I don't say much about it. I prefer talking about diamond and crusted pistachio
apparently
ice
the people in the graphics department are less shy. MSTA.
Right. Dylan, what is the rest of your day looking like?
It looks like watermelon and pistachios, and then podcasting this evening. I got Truth or Skepticism later with Tom.
Nice.
And then overtime. And then I'm going to swim. I do believe I'll do some swimming in between podcasts.
Nice. Right. Send my regards to the rest of the Tasty Gang. Trader friends, do stay with us because we have a special treat. We've got the Art of Investing podcast coming up next, part 1.
But it's nothing to be scared of. When people are selling off and panicking, now's the time to step in. Use some of that cash and put it to work in something that might give you a better, longer-term return.
So we have people putting their money in cash at the expense of putting in stocks. In doing so, they're sacrificing enormous returns.
If you're demanding more than is being supplied, the price will go up.
Little extra we've got in this podcast is yellow and red cards. Because believe me, these two can talk. And yes, I was looking at you there, sir, in particular. Because
I wasn't me talking.
Your capital is at risk. The value of your shares, ETFs and ETCs can fall as well as rise, which could mean getting back less than you originally put in. This content is for information purposes only and is not investment advice. Past performance is not an indication of future results. Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals. Brought to you by IG, the FTSE-listed global investing platform with over 50 years in the markets. If you're new to investing or are looking to sharpen up your knowledge over all asset classes, you're in the right place. Join me, Rich McDonald, and my co-hosts, Mark Spice Holden and Chris C.J. Fellingham, every Friday, when we bring you updates from the markets and insights from our combined 100 years of investing experience. But what makes this podcast different from all the rest? Well, we are launching our very own model portfolio run by the three of us, and through IG, we have access to thousands of financial markets for you to track our investment decisions. Every week, we'll update you on how the portfolio is performing and any changes that we are about to make. My background is that I was a fund manager at Brevin Howard and then moved on to be head of trading at Credit Suisse. That took me to IG, where I present the morning show each day, weekdays, with Trading Live with IG. And that brought me to meet these two wonderful gentlemen. Chris, introduce yourself to the listeners.
Hi, my name is Chris Fellingham. I'm a veteran of 40 years in the City of London. I've worked for some of the most prestigious asset management firms in the city, including BlackRock and working for Soros. I've invested through a lot of times when asset markets have been good, but also when asset markets have been bad, both bonds, currencies, and equities.
Well, that's a tough one to beat. What about you, Mark Spice Holden?
Hi, everyone. I'm Mark Holden. I'm still here despite working for Chris 5 times in the last nearly 40 years that I've been a professional investor. During that time, a bit like Chris, I've worked for some of the biggest and best investment banks around the world. To name but a few, Deutsche Morgan Grenfell, ABN AMRO, and Standard Life Investments. But my area of expertise comes down to being an equity and a commodity specialist within the teams that I've worked with. And I hope to bring some of that expertise to the team here today. And as we go forward with the exciting new podcast, which I can't wait to get going on.
So for everybody watching on your podcast, you will see that you could be mistaken for thinking we've grabbed these two guys out of the pensioners' queue at the local post office. But they really are my Warren Buffett and George Soros of the UK. And we were introduced a few months ago now. And after spending a 4-hour lunch with them, then I just knew we had to get them on film. We had to get them on record. Just having a chance of the 100 years of experience working in the city between us. I really wanted to get that out to everybody and the lessons that are possible. Chris, what drove you to say yes to doing this?
Rich, I've been very, very lucky that I've worked in financial markets for the last 40 years, and I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. And we as a society, we need to realise that when we think about retirement coming up, and closer for some of us than for others, Richard, you're going to probably work for 40 years, 45 years, and then you're going to retire for probably, given life expectancy, for maybe 30 years, 35 years. You need a lot of money in order to meet the retirement that you want for yourself. You may want to go cruising. You may want to do lots of other things. You may want to buy yourself lots of gifts. You need to be able to understand about the markets and how they work. And, having thought about that, we've been very, very lucky to find in IG a organization that believes, as we do, that we need to bring this to everybody and help everybody realize their dreams and their aspirations. And we're going to do that. This is the idea, and this is why we're now here. We're going to do that by explaining how the markets work, taking people in detail through how the asset classes move, deciphering what's going on every week and what's important and what isn't important, working towards a model portfolio and helping then individuals see that they can take control of their own destiny, their own investment story, and create a great future for themselves.
That's right. So if people are thinking about their pensions or just their investments, it's really giving themselves the chance of getting to that point of financial freedom. What about you, Mark? What drew you into this?
Well, when I first joined the city back in 1986, a long time ago, obviously, the city was absolutely full of old Etonians, the old schoolboy network, people who had been to Oxford or Cambridge or the Russell universities. And I got a drinking man's degree from Middlesex Poly in North London in accounting and finance. And I managed to talk my way into a job in the city and have been able to work my way through. But at that time, you really needed to come from one of those big academic sort of houses or backgrounds. It was very much an aristocracy running sort of stock markets and the city. I think now, thankfully, over the last 40 years, it has evolved into something that's much more like a meritocracy. It's much more inclusive. You see a lot more women in the jobs now, which is great to see. And thankfully, like I say, you are now judged on what you bring to the party rather than where you've come from.
And tell us, Mark, what do you bring to the party as our equity specialist?
Well, I say, I've invested in many different sorts of funds over the years. I've been an income fund manager, a growth fund manager. So I've been hunting around for dividends, and I've been out trying to find those great cutting edge growth companies. And I've been able to bring that from a bottom up perspective, understanding how companies work, and then understand how they fit into markets at different times. And the markets go through different cycles. And of course, if it's sunny outside, you want to put your sunglasses on, put a pair of shorts and a t-shirt on, and out and enjoy it.
Please. I'm beginning to think
you
that's
won't be
a
seeing
horrible
my
sight.
shorts yet. Yeah. And so I used to sort of invest like that. But if it's snowing, you want to go out with a big coat, and there are certain stocks and certain sectors within markets that are good for those sort of conditions. And it's understanding how they work within markets. Those are the sort of companies or stocks and sectors that you want to go after. Now, we're not going to be talking here about individual companies very much. We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money. If you buy companies, individual companies, you get much more specific risk. If the chief executive, God forbid, gets knocked down by a bus, then the share price could easily fall 20% if he was considered rated very highly, or go up if he was considered very poor. And so we want to try and take some of that risk away by investing in the overall stock markets, like the S&P 500, like the FTSE 100, and many others that you'll come to learn about in the future.
And this takes me to the real jewel in the crown of this podcast. I didn't want to just deliver another one, right? There's a new podcast coming out every single day. I wanted a financial podcast that was considered the best in this country. And how are we going to make this one different from the rest, Chris? What's the one difference?
But we're going to put it into action by creating our own model portfolio. So we are going to build up over the next few weeks to the creation of a portfolio which we will be running as a long-term investment vehicle to meet the aspirations return that we're looking for. We're going to set that return at 10%. So we're going to be looking to make 10% per annum, whether markets go up, whether markets go down. And we'll be able to show how what we're discussing in the podcast feeds through to the decisions we make on the portfolio. And hopefully then help educate the people who are watching the program to see why we're doing things, understand why we're doing them, and help them then take control of their own investment story.
And that's the great thing. So this is going to be powered by IG, by the IG platform. They've got thousands of financial instruments available. And we're going to go through each week what's happened in the markets and then a hot topic of the week. And we're going to take your guys' thinking and see how that develops into switching the portfolio around. Is it going to be a big switch? Is it just going to be tweaks? And that's what we're going to be looking at every week, which I am very excited about.
But I would like to say, in order to do that and to fulfill this education process, we're going to need to talk in detail about all the different asset classes that we can consider and when they work, when they don't work, and how we're going to be positioned in them. And then people are going to be able to see how that all comes together to give them the confidence to go and do it themselves.
So, shall we dive into it? What about taking a look at what has been happening recently in markets? Spice, we are at all-time highs in the S&P 500, in the FTSE, in the German DAX, even in Bitcoin. What has taken us there?
Well, there's no such thing as a dull week in markets, is there? And, the dawn across the Atlantic certainly hasn't let us down. There's been a huge amount of information come out, not least the world's biggest central bank, the Federal Reserve, released their minutes. And in there, they gave hints that we're getting quite close to a new interest rate cutting cycle in the US. Now, that's very important for asset markets. It does tend to buoy them up. There's nothing better for particularly equities than seeing an economy that's stable and then seeing interest rates come through as well. That's great for equities and powering them. And it helps part explain why equity markets are at all-time highs.
And we will be going into that in later weeks, a real deep dive into bond yields, interest rates, and why that, as you say, is such a positive for it.
Absolutely. But what we took from the last minutes this week was that actually they've got a meeting on the 31st of July, which is one day before the next tariff deadline that Trump's put in place. But we don't expect any cuts there. But however, on the 17th of September, which is their next meeting, there's now a 67% probability of a rate cut starting there. And then over the next 12 months, you expect to see another 4 or 5 rate cuts from the Americans. And they've been lagging behind what's been going on in Europe and even the UK, where we've been cutting already. So that was very positive, helped push markets up. Obviously, the other thing is that Trump managed to once again pull out the taco trade and kick the can down the road when it comes to tariffs.
Explain what you mean by that, Mark.
Well, to be fair, the
Oh.
Financial Times, I can't take credit for this, but the Financial Times coined a wonderful saying, which is Trump always chickens out. Taco. And I'm sure he's fuming about that.
I'm sure no one dares say that to his face, although I think a journalist did, and he got very angry.
Absolutely. I think he's banned the FT from some of his meetings now. But the FT is great when it comes up with that sort of thing. But nevertheless, it's proof that actually since his first Liberation Day sort of revealing of the tariffs, where it shocked lots of people, it's been right to buy the negativity on that every time in the stock markets, and they've gone up and gone much higher ever since.
Yeah, 24% rally in the S&P 500 from the lows of that Liberation Day.
Absolutely. So he tried to threaten people again. He said he's sending out 12 threatening letters to other countries. But frankly, there are only 3 that haven't come to a trade framework deal yet. That is Japan, the European Union, and South Korea. Those are the only ones that really, there are lots of others, but the ones that really matter for stock markets and investment markets are those 3. Now, it sounds like the EU are very close to doing a deal. Japan probably won't be far behind, and South Korea will do their own thing. But they're all linked, those 3 countries are all linked to very big automotive industries. Trump has put 25% tariff on all cars coming in to the US from those countries.
Do we have any idea when they're going to be, some of those might be announced, the European one, for example?
The European one should be by the end of this week. So probably when this podcast is coming out, hopefully there'll be one out there. But that's the one that sounds closest. I think Japan is proving a bit more problematical because the Japanese are digging their heels in a bit. And rightly so, they've got to fight back against this guy from time to time. And who knows? But I'm sure they'll come to some sort of agreement. They always do. And if they don't, the markets in Japan will go down 2 or 3%, and then they'll bounce back up again. I think it was illustrative, actually. Trump put in yesterday a 50% tariff on Brazil, totally out of the blue. Brazil was meant to be a 10% tariff, as we've got in the UK, and he put a 50% tariff on.
Which was a political move, and that's, I don't think we've seen that before, have we? Tariffs used as a weapon?
Not really. I mean, you could argue all tariffs are a political weapon, but at the end of the day, it shocked people. But I think it was interesting to see how their markets and their currency reacted. So their currency fell 3%, which partly offsets some of the tariff increase, not the 50% that he's talking about. And then also the stock market fell about 2% yesterday. So if that's a 50% tariff, then actually we don't really have a great deal to fear if other countries get hit with a big one, for example, in Japan or even in Europe. So, I think that was a sort of a marginal positive to be taken out of it, even though it came out of bad news.
Now, a further little extra we've got in this podcast is our yellow and red cards. And I think you were sailing close to the wind there, because believe me, people at home, these two can talk. And so I felt I needed a way of controlling. And yes, I was looking at you there, sir, in particular, because
wasn't me talking.
Our first lunch together was 4 hours and our second lunch together was 7 hours. And I don't think there was a quiet moment. So if I feel that these two are going on a little bit too long, they will be shown a warning. And if they continue on, then there will be a sin bin action. So don't you worry, people at home. I will be keeping on top of this.
And who's saying it to you?
Yes.
I will just keep those out of your reach, actually. Now, we talked about tariffs, and of course, tariffs feed into inflation. Inflation dictates interest rate policy. So from my bond expert, do you have a little bit to add on what's going on at the moment?
I got a couple of things to add. The first thing I would add is looking at things in a broader picture still, just for the risk of a yellow card. There's an expression that an equity bull market climbs a wall of worry. And so while there is still things to worry about, I think you can be reasonably confident that equities are set fair. So when Trump moves his tariff date to August the 1st, that gives you more runway still to push these prices higher. It will be very interesting to see what happens on August the 1st. And if we can get there and all the deals are in place, and then you're going to wonder what else is bearish out there. And in fact, is everybody going to turn more bullish? So I think you can stay safely looking for markets to rally for the moment, but let's be careful about when we get there, because we are up at all-time highs. Things have done very, very well indeed. It's been a great year for investors generally.
I think just to pause there, you mentioned bullish and bearish. Can we just teach everybody that doesn't know where those terms come from? It is, of course, the angle of attack, because a bear attacks from above downwards and a bull attacks with the horns up the way. Those terms have been used since the beginning of markets, right?
And there's statues of them outside Wall Street. So, they are used as characterizations of the types of market that you're in. And essentially, as an equity person, you spend most of your time in a bull market. Prices are going up. As a bond person, you spend most of your life in bear markets with prices going down. You mentioned bonds. If you'll let me just mention quickly bonds to people. We're going to spend one of the sessions coming up, one of the future podcasts, talking about bonds in detail, because bonds are extremely important for the valuation of asset markets. They feed through in every way. They're complicated to a degree, so it will take some time, but we are determined to help people understand them so they can see why you should be looking at where bonds are. The good news for most people is most of the time bonds are really boring because they don't move very much. And actually, at the moment, they are being quite boring. They're allowing the politicians to play fast and loose with fiscal policy, with borrowing lots of money. Because remember, it's the bond markets that provide the money to the governments to spend it.
And just say a little bit more on that, please, Chris.
Yeah, of course. So if you take a country, you look at its outgoings and its incomings. Its incomings are tax receipts. Its outgoings are what it spends its money on. And you will have heard many commentators talking about the big budget deficits that we have around the moment. What a budget deficit is that you're basically spending far more than you've got coming in. So you've got a financing gap. And the bond market walks in to fill that financing gap. It's an IOU. You lend money to the government. The government says, I promise to pay you back that money. And they pay you a financing fee, the coupon, the dividend yield, as you were talking equities, the income you get, and you get your money back at the end. So bonds are very safe, very stable. Now, there's lots of different sorts of bonds. We will be talking about those in another podcast. But bonds at the moment are accommodating all this borrowing.
Mm-hmm.
Yes, we are seeing some pressure on those bond markets, but not enough yet to unsettle the equity markets. So if I was to look around at things, I said earlier that you've got an equity bull market, you've got things to worry about in tariffs, you're not worrying about the bond market.
Okay, well, that's good to know, because we can worry about equities, we can worry about bonds, but also we're going to talk about commodities such as oil, such as gold. But there's been a story in one commodity this week that has caught your eye, isn't there, Mark?
Well, absolutely. I mean, Trump came out of the blue. We knew he was assessing a potential tariff on copper, and he's put a 50% tariff on all copper being imported into the US. Now, you may think that that is shooting yourself in the foot, which it probably is, given that America consumes about 13% of the world's copper, and about 7% of it comes from their own copper mines across America. So they have to import another 5% mainly from Peru, Chile, Canada and Mexico are the main places they import it from. And though that copper is going to have an extra 50% put on the price. So if you're a US manufacturer, you're going to be fuming about that.
And what industries does copper especially important for?
Well, it's particularly important for electronics, electrical wiring, and phones, computers, etc. It's a conductor, major electricity conductor. It's the most efficient one out.
And for the green revolution, of course.
Absolutely. So, but the biggest consumers are wiring and electronics. The next 20% goes into construction. If in your house at home, you've got hundreds of meters of electric wires that are copper wires.
And this is why the railroads have to watch in particular when the copper price goes too high, because there's people come up and try to tear up the rail tracks.
Yes, that's why there's not much lead on churches around the UK, because when the lead price went up, everyone went and stole the roofing from churches, sadly. I wasn't one of those people, obviously, because I want to go to heaven. But of course,
you won't do that. Not a chance.
And when it comes to having a diversified portfolio, then we are going to look at all these things, aren't we? It's not just going to be an S&P 500 tracker or the FTSE 100. We're going to look at gilts. We're going to look at treasuries. We're going to look at copper, oil, gold. And I think that takes us very nicely into our hot topic of the day. And that's a report from JP Morgan, the mighty house of JP Morgan. Chris, run us through what it's trying to get across when it talks about people's portfolios, their ISAs, their SIPs, and their savings.
Okay, so first of all, a little shout out, as you say, to JP Morgan Asset Management. They did a paper about 3 weeks ago called The UK Savings Opportunity. And it was a really, really interesting report summing up where we were in the UK with regard to UK investors' savings. There were 3 main takeaways that I found.
Okay, so the question was, where do you think gives the best possible returns for your long-term investing in your retirement?
Correct. And so there's the chart, as you will see, if you've got it in front of you. If not, I will describe. The most important bar on the chart is pension funds, and that's about 26%. So we should be really grateful and happy that people have realised that for retirement, a pension fund is a pretty good idea. But I am rather concerned that 74% of people didn't answer that question in that way. What concerns me even more was the second bar, which was don't know. And don't know was 25%. So 25% of people hadn't got a Scooby-Doo what they should do for their long-term investment vehicle.
If ever we needed a underlining of the reason why we decided to do this podcast.
Correct. The third bar was property at 20%. So obviously property is very important in the UK, and maybe we'll talk about that in a moment. At 10%, you had easy access cash savings. So far, we've done nothing apart from the really safe traditional ways that we would expect. Stocks are down at about 9%.
Wow.
Cryptocurrencies are at 4%. So stocks are only just above cryptocurrencies, and government or corporate bonds are down at 3%. So you can see from those numbers that we are a long way away from people realizing what the alternatives are for where they can put their retirement savings.
And why does that alarm you so much? What kind of stats back up the argument that that's wrong?
In this document, they talk about the level of returns since COVID. And they talk about if you held cash or if you held the world stock market index. So they just talk about those two, but I think the conclusions are valid. They look at those returns in a real way. So what that means is, what is the return? And then you take away inflation over that period.
Okay, so every year you can take off inflation from the return.
So
that gives, what do they call that?
So it's called the real return. And the real return is the gross return minus the inflation rate over the period. The MSCI, which is the World Stock Market Index, so that represents all the world stock markets, so all the companies in the world in their proportion relegated, consistent with their market capitalization, has done 39% in real terms over that period. 39% in real terms. And in that period, remember, we have had inflation up to 10, 12, 13% in one particular, if I remember correctly. Cash has done minus 9%. So we have people putting their money in cash at the expense of putting in stocks. In doing so, they're sacrificing enormous returns.
Yeah, that's real wealth creation against wealth destruction, isn't it?
It is. And even more in this document, they then go to the people who chose cash and they ask them, why did you choose cash? One, easy access. Well, hold on a minute. Everything we're going to talk about on this podcast will be easy access. They will be ETFs, stock market indices, very easy for everybody to see what they should buy and how they can deal in them. 25% of them were afraid of losing money. And that, I think, is something that we have to get across and help people to understand, that although in any one particular year, it is possible that the stock market will do badly, all the evidence suggests that over the long term, stock markets produce excellent results. And as you can see, since COVID, an enormously extra result through the world stock market index to cash.
So 25% were most worried about losing cash. Was that the Scots?
It doesn't go down to a geographical breakdown. It certainly would be consistent with the Scots that I know. But hey, I don't know them all, do I? So that I thought was really interesting. They coin a phrase in it. They say, saving is good, investing is scary. And they say that's what they see coming through here. And I thought that's a lovely way of describing from their numbers what you can see coming through. And I think what we need to do as a podcast is we need to get that. We need to change some of this round. We need people to understand that savings is good. Investing isn't scary. It's the right thing to do to get that wealth accumulation over the long term.
There was a great statistic I heard, and it was going back to 1913, right? If you had $1 in 1913, in real terms, by this year, you would have lost over 99% of your spending power. If you put it in US Treasuries, that dollar would now be worth $1.20. Okay, it's kept up. If you put it into the stock market, it would now be worth $1,350. That's the kind of difference that we're talking about over the very long term between investing and between just getting your cash and putting it under your mattress. I bet there's a bit of cash under your mattress, Mark.
I wish. Mine goes on nice bottles of rosé and long lunches with you guys. But talking about the amount of cash in the world, I looked up actually this morning. So in America, you can look up the amount of cash that's being held in short-term deposits and money market funds. And there's $7.4 trillion sitting in these cash funds at the moment. Now, to give you some perspective on that, the whole of the US S&P 500 stock market, which is the biggest stock market in the world, is 55 billion. Trillion, yes. So, look, big numbers, obviously. But so there you basically got 14% of the S&P effectively sitting on the sidelines. Now, imagine if just some of that money got put to work and put back into stock markets. Stock markets would go even higher. And that would probably be the time that a few grey hairs around this table would say, maybe it's time to start selling it. But now,
I don't
it's
see
still
that
on the
many grey
sidelines.
hairs. I think you're
ash blonde.
Yeah, the ash blonde around the table might get negative.
Historically, the Americans, and to this day, are much better at investing in numbers. Over 60% of Americans hold stocks, don't they? Whereas it's less than 30% in this country.
Yeah, it's derisory. And I think, that is partly the industry in this country has not been very good at educating people. The government haven't been very good at, and that's whether you're Labour, Conservative, or whoever party you believe in, they should be educating, people about the potential returns in there. Because, if I can pick out some numbers now, but if you go back since the Great Depression to now, equities have returned 9.6% on average each year.
And sorry, that was 1966, the Great Depression, wasn't it? Is that right?
Only if you're Scottish. But since 1928, equities have given 9.6%. Bonds have given 4.6%. And cash has just given 3.3%. Now, as we said earlier on, and you take inflation off of that, and inflation has averaged 3% over that time, cash has only given you 0.3% real, so above cash. Bonds have only given you 1.6% above cash. And by the way, if I was paying a wealth manager 2 to 3%, and he was going to give me 1.6% after inflation every year, I'd be disgusted. I would be absolutely disgusted. And one of the great things about the portfolio we'll bring, it's cheap. IG give people access. Anyone can have access to this sort of thing. And it's cheap and easy way to get in, and you don't have to pay a very expensive wealth manager to do it. But the punchline is that equities have returned 6.6%. So far and away, the best average returns. Now, even this in the last 6 months, just think what has happened in the US stock markets this year. They fell 20%. The S&P fell 20% from Liberation Day, where Trump revealed his new tariffs, 67% on China, et cetera, and they're now bounced from that level 25% higher. They're bounced from their low 25%. So they're higher now than before that, all in the space of 3 months, 4 months. And that is, quite extraordinary. But it's nothing to be scared of. That's what we go back to say. Some of, our experience will hopefully tell people when people are selling off and panicking, now's the time to step in. Use some of that cash and put it to work in something that might give you a better, longer-term return if you've got that time horizon, which we're going to try and hopefully convince people that it is good to have a long-term time horizon when you come to investing.
Yeah. Now, a lot of people's main investment is their house, and we know that property's in there as 20% of people think that that's the best investment vehicle for their retirement. That's very much a British thing, isn't it? Did everybody just play Monopoly when they were a child, or what's given them that kind of viewpoint?
Well, for those of us who've been around long enough, I saw the tail end of Margaret Thatcher coming into power. I remember the mornings I was told that she'd won the election. And she's a very Marmite character, of course, very divisive. You can't mention the word in my family with 3 children. And one particularly lives in Manchester, so they definitely hate her. The Scots will definitely hate her. But what she did for this country was completely change the attitude towards property, because she passed a bill called the Right to Buy. Mm-hmm. So if you lived in a council house and you'd been paying rent for years and years, you could buy your house at an accumulated discount, depending on how much rent you had paid into the state, if you're to a local authority. So people were able to buy their houses, their council houses, from the government, 30% lower than they were valued the very next day in the market. Now, that's what we call in the markets a no-brainer trade. You buy something 30% less today, you sell it tomorrow, and you've got made 30%. Why wouldn't you do that? Now, over the time she was in power, and that was a decade or so, the discounts increased and increased and increased. At some point, people in flats were able to buy flats at 70% discount to what the price was in the market the very next day.
And that was to increase the incentive for them to buy.
Absolutely. Basically, they wanted to get people into the habit of saving, being responsible for their own property, taking that personal responsibility. And it has made this country a lot of money. And, there are a lot of people who are asset rich in this country because they own their own house. They may not have a lot of cash, but they're very asset rich. And they're very proud. People, in the Brits, we like owning property, and this is part of the reason for it. If you go to Europe, people rent their properties.
Yeah, but this has been passed down from generation to generation. And now youngsters don't feel that they've got the opportunity, because you old boys are just hoarding everything. So now it's really hard to get on that property ladder, especially with interest rates above 4%. So the taxes, the additional stamp duty, is there a shift in ideas now? Is there a shift in opportunities maybe that there was back in the good old days?
There were basically two reasons why you could say property was going to be a fantastic investment. One was at the same time as Margaret Thatcher, they were deliberalising the lending markets. So people could have multiples of 4, 5, 6 times their salary. And that would, work well. And then there was a supply shortage. And the supply shortage was people weren't building them. But also we have had quite a lot of immigration that's come into this country as well, which has been creating that a supply-demand imbalance that Mark talked about earlier, where if there's a lack of supply and lots of demand, prices go up a lot. And so people got used to the idea that houses were the right place. Now, if we look at things now, I'm not as positive on property now. I think Mark and I slightly disagree here. But, to me, we've got a government plus all governments saying we need to build more. We're going to try and get that size up. Now, clearly, they're not doing as much as they would want to now, but they're going to keep trying, I would expect. Financing is not as easy to get because mortgage rates have pushed up.
Mm-hmm.
And therefore, you're going to find a situation where people are looking to offload their homes, especially as well that the council tax has changed on second homes and third homes and fourth homes, where now they're charging double council tax on all those.
Yeah.
You go and look round at the coast now, at the seaside towns, lots of things are for sale now because people are getting charged so much. So I think what you're finding is that balance is turning around. And so therefore, now is a good time for people to think about, well, maybe my house isn't the right place for my investment monies. Maybe I should now be putting that money into the stock market, into the investment markets, which is what we're trying to address here in this podcast.
And certainly that longing to, as soon as you can, get that deposit down on the house. Maybe it should be the longing to build your ISA up and to get that invested and do it the right way and do it in a diversified manner. And I think, again, this model portfolio that we'll be running, people actually see the way that such professionals as yourself have been doing over that time. Mark, was there an opportunity for you to invest in housing? Was there a way to do it through equities?
Yes, you can do. There are lots of different what you call REITs, retail real estate investment trusts, basically.
Okay.
They're investment vehicles which take all of the income that a property owner gets and distribute it as a dividend, if you like, as income.
Right.
So there are ways of doing that. But I think, one of the things that the government, that plays to property, which is underestimated, is it's your first house, your main house, is tax-free. Now, what the government have to do is, and we don't want to be political in this podcast at all, but what they need to give you some sort of tax-free vehicle, like an ISA, like a SIP, where you basically are encouraged, but that you can get very cheaply through people like IG, and you can inject other assets in there where they become tax-free. So if you invest continually in ISA every year from when you're 18, 19 and first start work, that'll build up a huge amount of tax-free wealth, which until now people have used in their house because that's been your principal private property. You can sell tax-free. You don't have any capital gains tax on it. And I think that's something that has to be massively encouraged. Sadly, it's not as encouraged as we would like it to be.
Yeah. And Chris, what did you see over the years? Were there some funds that you worked for that were more interested in property or more interested in bonds specifically, or what were the opportunities?
We as a investment industry, if we go back over the years, have always been very, very keen on commercial property. So you will find a lot of the old insurance companies, a lot of the old pension funds will have very large weightings to commercial property. People would say you can't go wrong with commercial property. You buy a property, you let it out. There were upward only rent reviews, which for people on here, you won't have heard of them because they're quite old. But what would happen is every 5 years, there would be a rent review on a property and it was not allowed to go down. So if the worst it was going to stay where it was, but the probability was it was going to go up by X percent. So if you owned an industrial unit, let out to somebody, After 5 years, you say, put my rent up, and I'm going to put your rent up, and then I put it up again, and I put it up again. So people said it can't go wrong. They have been completely taught a lesson by COVID, because COVID, with the changing work patterns of people, moving people away from the office sector, from Amazon and our friends delivering everything, so people don't have to have shops. The commercial property world has had a very bad 5-6 years. I'm afraid they've had their comeuppance, and now, once again, it pushes you more towards these other asset classes. If I had time, just to quickly mention 2 other things that I think are really important here. In this survey, we talked about the younger cohort and what their thoughts were with regard to retirement.
Yeah.
Half of them said they had no plans for retirement because it was too early. And of those saving, they didn't need to think about long-term returns because they don't plan on retiring anytime soon.
Well, they won't with that attitude.
Exactly. And they've we have failed. They haven't. We have completely failed to explain what compounding is and how returns compound over time. And therefore, if the earlier you start investing, the earlier you put it away in these strong long-term returning assets and just leave it, the more wealth you will accumulate. I have some examples, but I don't know if I'm going to get a red or a yellow card if I'm going to get them.
Okay, well let's talk about realistic numbers. Let's say I've got £1,000 to start saving with, and from my salary I can afford to put in £100 a month. How does that develop over time? Because obviously, as a man in my 30s, I can still start.
I'm sorry.
early.
I'm sorry. Can we have a checking query there?
Just for numerical purposes.
Red card.
Yeah, red card. Okay, so if you have 30, if you were 30 years old, put £1,000 in an account, and you put £100 in then every month at 10% return each year. So nice, easy for people to understand.
Which is what we're aiming
Age 60, you'll have £250,000.
250,000 from 1,000.
From 1,000 and 100 every month, compounded at 10%. And that's because every year, it's all going up by 10%. It's all going up by 10%. It's all going up by 10%. That's the power of compounding. If you're 40 and you do that, you'd have £80,000 at 60. So you've gone from 250 to £80,000 by missing that 10 years. Think about it. That 10 years is absolutely critical. That's what we've got to try and get across. And the final one, at 50, well, basically give up. At 50, £1,000 to start with, then 100, you've got £18,500.
Oh, £18,000. And then if you start at your guys' age, then you've got £1,000.
It's a good job we don't do ageism on this podcast. Otherwise, I think I might be writing to HR.
Good stuff. Well, that's been a fantastic introduction. I feel I'm really happy about that. And normally at this time in the podcast, I would be taking the viewers' emails, because what we're going to do is have stories. We're going to have questions from my 2 gurus here. But of course, week 1, we don't have that. So we'll maybe just explain how you can get in touch with that. And that is by writing to theartofinvesting@ig.com. And what kind of things would you like people to email in with, apart from when we should have used the yellow card this week?
I would like people to ask us questions related to, and clearly this will be more relevant as we go further on, but how they form their portfolios. What, given their thoughts on risk, given their thoughts on return, given what we've said in the podcast, maybe a bit more explanation about something so they can, it will help them in that journey. Because clearly all we're providing is a model portfolio of what we would do. Clearly it's up to the individuals to take control of it all themselves, but we want to give them every tool in the armory to help them do that. So any question about anything, we'd love to hear bad investment stories. I mean, I've lost so much money over my life in various trades and various things, and they'll come out of the time. A number of listeners who are listening to this will say he has, and I can take you through those stories as well. Maybe they will write in and talk about, do you remember when? But these are all the lessons we learn, and the reason we've got the grey hair and we're still here, and we want to help people by educating them with those things.
Yeah, and certainly if you have worked with either of the chaps here. We'd love to hear your stories from back in the day as well. So feel free to drop us an email. That is theartofinvesting@ig.com. Mark, what would you like to see come in? What questions do you think will arise?
Yeah, I think things that are interesting the listeners more than necessarily what we think they're interested in. If there's a subject we haven't covered, then we'd love to know about it. And even if we don't know much about it at the time, which probably is the case, we will go away and do some work, because as Benjamin Franklin once said, failure to prepare is preparing to fail. And so we need to prepare for those sort of questions and, have insights into other parts of the market and new and evolving sort of areas. Like crypto 5 years ago, no one was really interested. Now everyone's interested in it. And, there's been a lot of lessons learned there. Boy, there's been a lot of lessons learned there.
A lot of money lost
and
there as well.
We will undoubtedly talk about that at some point. But actually, the ones that have survived this big sort of sell-off and crushing are probably going to be quite interesting. We may even put some in the portfolio. You never know. But, that's for debate, and that will come. But anything that on the edge of financial technology that people are looking at and thinking about would be fantastic to hear about.
What is the biggest bubble that you have seen in your career?
Well, until the crypto bubble burst last year, or the last couple of years, it was definitely the tech bubble. I worked through that, and I was very fortunate to work for one of the most sort of forward-thinking investment houses at the time, was Deutsche Morgan Grenfell. And we were very early on in investing in companies like Arm, which is now a global leader. And that company came out of the BBC. It was BBC's Acorn Computers.
Right.
Arm was started from that in a little office in Cambridge. Ironically, then they sold out to the Japanese. The Japanese then sold it back, and it's now quoted in America, not in the UK. And yet the headquarters are still in Cambridge, in England.
Incredible.
But there we go. But the tech bubble was a bit like the crypto bubble, and there were lots of people trying lots of tricks to try and create value from something that wasn't there.
Yeah,
they
and
were
when
lying
you say
about
crypto, you're talking about all the meme coins and the altcoins.
and Dogecoins and all these other things. I mean, at the end of the day, there'll only be a few survivors out there. These big bubbles that happen out there, and Arm was a big survivor out of the previous tech bubble, but most of them disappeared. And it goes back to what I was saying about supply and demand. People wanted to buy all this technology, a bit like they are going after AI at the moment. But there wasn't enough equity, or wasn't enough ways for them to get exposure to that. So people were just inventing things. They had students sitting in rooms pressing return keys on websites to show that they had a number of hits on their websites. They were completely cheating, but it was worth it because they had a company that was going up, 100 times every couple of weeks. And we've seen, that was just mind blowing. And luckily, we've seen that sort of thing before, and we saw it again in crypto. Luckily, Chris and I saw quite a lot of that and managed to step back from those sort of things.
Yeah. And I think, that's a great thing that we will cover, the risks. It's very easy when we're at all-time highs to maybe forget about the risks, but we are very much going to focus on those. And hopefully over the time period that we're doing these, we will see a bit of volatility and we'll be able to tap in.
But you see, it's not just equity markets that see bubbles. So, for example, if you think about the government bond buying that happened in 2012, 2013, 2014, where they set interest rates at very low levels and then they did lots of buying. They actually set interest rates at negative levels in Europe, i.e., if you put your money in that bond, you paid them
to look
after your money.
See, the
and
Germans
people
could think
did that. And for a year and a half, bonds were negative yielding. And they've now moved up in yield by about 4%, 400 basis points. You'd have lost 50 to 60% of your money buying those bonds. So the asset classes get into bubbles a reasonable amount of time. I would hope that our grey hair, ash blonde hair of my colleague over there, I would hope that we have seen enough of them to recognise when they're forming. And although we may not be able to say exactly when they're going to end, we know when it's time to take the ball away and stop playing the game.
Now, talking about seeing enough of people, if you have enjoyed today's episode and you want to join us again, then look out for the next episode coming out next Friday in your chosen place to consume your podcasts. Should everybody at home follow and subscribe their new favourite financial podcast chats?
Absolutely, they should.
Definitely.
So if you've enjoyed this episode, please leave us a review and tell your friends, tell your family. And yeah, we very much look forward to seeing you again next week. Gentlemen, thank you very much. It's been an absolute pleasure.
Thank you.
Thank you.
Stocks go nowhere. It's Tuesday, July 22nd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Dylan Radigan in Milan, Thomas Westwater in Chicago. Thanks for stepping in for Elliot today, Thomas. We're here to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade, if you're on the website, tastylive.com, thanks for tuning in. Come over to YouTube. Tell us what you think of today's action. What you think of the rumors that Fed Chair Powell was resigning, only for that to be an AI-generated dupe. The market did flash down a little bit weaker, only to rebound immediately thereafter. And outside of that, it was a fairly unexciting day in these markets where tech stocks were down a touch, NASDAQ off by about 0.5%, S&P treading water, the Russell leads the way higher with healthcare, getting a nice little bit of a bounce leading sector today. Bonds continue to show signs of improvement at the long end of the curve, which may be one of the reasons the dollar is struggling here. And Dylan, we're going to have to draw into question our dollar strength hypothesis at this point in time. But it's been good news for gold and silver, and that's probably good news for the three of us. Outside of that, energy churns. Guys, we are getting ready for, well, the second half of this week where we have some interesting earnings coming up. Google, Tesla, IBM on the docket for tomorrow. Dylan, I apprise you of these rumors that the administration is trying to convince people that Fed Chair Powell is going to be resigning momentarily, any minute. Why are they doing this? Why are they forcing this narrative on the market, despite Powell's insistence that he's not going anywhere?
So my speculation, I obviously don't know why they're doing this, but my speculation is this. I believe that they are aware that the tariffs for which they advocate and have implemented have had an inflationary impact and represent a drag, a slowing effect on economic activity and an increase in inflation. Targeting Powell as a bad Fed chair or as a Fed chair who's not doing what he's supposed to do is a way, in my opinion, of distracting from the consequences of the tariffs. It's basically the Powell targeting is a way to redirect attention away from the negative economic consequences of the tariffs, meaning slower economic activity and higher inflation, by assigning responsibility for the economy or any negatives in the economy to the Fed chairman and suggesting that if the Fed chief would simply reduce interest rates, that the tariffs would be able to advance without causing any negative consequences. And so I think that the reason that they're targeting Powell is, one, as a way to distract from the negative effects of the tariffs, and two, because there's a constituency of people that are inside of the MAGA base that are also aligned with the idea that the Federal Reserve is a nefarious or illegal or misguided organization that needs to be confronted anyway. So there's the political points of sort of going to war with the Fed, irrespective of economic considerations. And then there's the icing on the cake, or sort of the primary motivation even, which is to redirect blame or concern about any weakness in the economy away from the negative consequences of tariffs and point it to the Fed chief. So I think those are the two primary motivations to do it, although I do wonder whether a lot of the folks that are actually doing it even know why they're doing it, other than the fact that they're doing it because the president did it, and they're just sort of mimicking the president's behavior at the end of the day.
Thomas, we find these headlines to be ridiculous, and pointless. I'm getting to the point where they're getting a little tiring from how they're continuing to flood the market. The market didn't react that seriously to them today. Again, it was a brief little bit of a pullback here. That's this on the chart, the 2:15 p.m. candle. What are we doing here? I guess, like, how do you even react to this? Because it seems like day traders just completely look through this today, and we're happy to buy the dip.
Is the 2:15 candle the fake Fed press release or whatever it was?
Yes, Mike Lee and MAGA World Media, Benny Johnson and the like.
Yeah, I mean, it's easy to put Fed as the scapegoat when a certain portion of your followers already sees entities like the Federal Reserve as this ominous cabal of government conspiracy. But it's interesting, you know, it's like when Twitter got first taken over and you saw fake tweets from companies that would actually impact the price. But when you looked at the press release, it was pretty easy to see that was fake. The logo was just gibberish, things like that. But I'm surprised there was even
Thomas,
a
do you
reaction
think you agree with my reasoning?
Yeah,
do you think there's another
I think
motivation?
you're spot on.
Yeah, this was the logo, by the way. This was being passed around as legitimate news today.
I mean,
You zoom in
it
for
almost
a quick,
looks like Latin. I mean, I guess the top.
This is, if you've ever used ChatGPT to generate text on images, this is the kind of crud that comes out of the system. And forget the fact that, like, the Leafs here. I mean, just the whole thing. If a U.S. senator is retweeting this information as legitimate, we are so cooked, Dylan. We're so screwed.
I mean, but do you think that the U.S. senator is doing it knowingly or unknowingly?
It's hard to even tell.
I don't think it's hard to tell now. Yeah, I think that's the case here. But where the market bottomed out today around the news and where we found our low today, I think is the more interesting conversation, because we never crossed a key technical threshold in either the NASDAQ or the S&P. If we're to believe that the previous trading range in the NASDAQ was 22,800 up to 23,100, about 300 points wide for the bulk of July so far, we find support today at 23,108, pretty darn close. Not going to fret over 8 NASDAQ points for an exact touch. So the uptrend is thus far maintained off of the low that we have here on June 22nd and again on July 16th. You can say the same thing about the S&P 500. We haven't exactly cracked into the previous trading range. And then our beloved Russell, our favorite 2,000 companies in America, they find support at the uptrend from the April, those June swing lows so far. So stocks aren't out of it right now. I'm not leaning any long deltas in equities, though, here, Dylan. You seem to be much more confident still to continuing flying close to the sun. I've decided to take my parachute before my wings melt off. How do you view the stock market?
I just like that. I'm with Nikki Batista from yesterday, where I just think that the earnings cycle and that the earnings headlines and the earnings guidance and just sort of the nature of the companies that are about to report all represent a fairly positive, a buoyant force for the stock market, I guess. And so, I mean, that's the essence of my continued optimism, is that, you know, we, as I mentioned yesterday, we sort of moved through the inflation data, and we're teeing up what I think should be some fairly positive earnings reports from some of the biggest names in the technology space.
Thomas, I know that you take a little bit of a closer, more granular look at individual companies' earnings than I do, and we certainly do have some important ones coming up here down the pipeline. Google, IBM, Tesla over the next day or so. That really kicks off our mega cap tech names. What interests you more at this juncture? Is it what's happening with Tesla? Is it what's happening with Google and their AI? Or are you looking for trades in either of these particular companies, or more as bellwethers for the broader NASDAQ?
I mean, I have a short put spread on in Tesla. I'm going to hold it through earnings. I like Tesla for an upside play because it hasn't participated in the rally, you know, compared to some of the other big tech names. And at this juncture, I think it just needs to avoid a worst case scenario earnings report. As long as Elon Musk says something positive about robotaxi or something, it's not going to matter, you know, what the numbers really were, unless they were really, really off. The market just wants to, the robo-taxi thing is the big thing right now for Tesla. I think it's going to go up after earnings. It's been kind of a laggard here for a while. And in this environment, if the rally is going to continue, I think Tesla has to catch up at some point here.
Dylan, I'm thinking about our point of view going into the previous earnings report, which was effectively things have been so bad. I mean, check the tape, right? They were firebombing Teslas, as we noted. So the negativity was basically baked into the stock price. As long as the company remained a going concern, how much worse could the news flow get? Since then, after alienating his liberal customer base, Elon Musk goes into politics, and he then crashes out calling Donald Trump a pedophile on Twitter very publicly. So I don't know if we should be expecting a lot of positive sentiment behind the Tesla brand still in the second quarter. I mean, I have a very low bar here. I'm expecting another disappointing quarter in terms of actual sales, Thomas. I think you've nailed it. I don't think the numbers are really meaningful whatsoever, as long as the company's staying in business. I mean, that's how low the bar is in my book. And if they have any glint of positivity towards AI or robo-taxis or Optimus, the market's going to be looking for a new point of speculative interest. Dylan, I know that you've been playing Tesla in the past through short put spreads as well, which has been obviously very efficacious. Do you have any strong opinions on it here now that it's trading at 332 ahead of earnings?
I mean, it's kind of boring, but it's really the same opinion, which is put spreads going into earnings, with a little room for error on the south side, so not too tight. But there's no way Tesla's going out of business, and there's no way that the most recent quarter was as bad as it may not have been significantly better than the previous quarter, but that report 3 months ago was such a horror show that it stands to reason that even if this is not great, that it will be slightly better, and that the belief probably is that as more time passes, that the half-life of the memory of the Musk participation in the government will continue to rot out and work to the benefit of the company, and all those play towards the value of selling some put spreads with some room for error, I guess.
Not just Tesla tomorrow, but Google as well, which despite the NASDAQ sluggishness today had a very nice performance. The NASDAQ was down by about 0.65%. Google was up by about 0.65% here, so a little bit of a mirror image going. Google's had a nice run, though, and volatility is creeping up, a 40.8 IVR. Dylan, it's not Apple, but it feels like Google and Apple have been the two FANG names, Mag 7 names, that outside of Tesla, for those obvious reasons, these have probably been the two more disappointing stocks of that group. If we can get Google and Apple over the hump, is that really the key for the door for this next leg up if this rally is going to continue? We need the behemoths to punch above their weight again.
I mean, yes, but I think I think the short answer may be yes, but I also think that there's more than one way to get there.
Okay.
So that's one version of it. But listen, the best thing would be for Apple to show some signs of life, because I think it's the most disappointing of the group. But also, if Apple doesn't show any signs of life, as a stock, it doesn't mean it's going to be a problem. Particularly when you have so much activity available from Tesla, from Google, ultimately, even from Meta and these guys, even though they're not reporting right now. So I don't know. I guess, Google, let's put it this way. Your best case scenario is a beastly guidance from both Google and Tesla. But even if you don't get that, it's hard to see how these names disappoint or how the stocks get blown up at this point.
Thomas, tech stocks today, they were the underperforming group. They were down by 0.93%. Semiconductors, which I know you've had an affinity for in recent weeks and months, were down by 1.77%. One, I guess the question is, are you still involved in the semi sector? Do you have any trades on there? And two, if not, does this pullback to its 1 month moving average today. Is that enticing enough for you to start engaging on the long side again?
Yeah, there was NXP Semiconductors had a bad earnings report, dragged down the sector a little bit today. I look at pretty much the same thing as you. The 21-day EMA, we're right there. I think it's a decent place to buy, especially as we move more towards the second half of the earnings season with Nvidia. I think you look at the chart. This level has held several times on pullbacks. So if you're going to get long, I think here is a good place to do it.
You mentioned that against that 1 month moving average in recent months, particularly since the low that we had here in April, it has swung up to become a point of support. Maybe this is touch number 4 in the market, but we've seen, once you get that cross here in the third, fourth week of the month, you get that elevation in semis. So perhaps today was that swing low. It really looks nice if you're operating on the long side. I think that's the 281 level. We'll call it 281, 282. As long as we're above there, longs still feel somewhat comfortable, even if we've given up some of the gains. But the semiconductors were one of 2 indexes, or rather ETFs, that were lower on the day for the sector performance. Our top performers were all related to home construction as long end rates continue to come in. ITB was up a whopping 7.88% here. The housing market still seems frozen, though. Existing home sales, those are coming out, but we've seen the housing data in recent months sour. Dylan, I want to throw out a different angle on this because I heard this throwaway comment yesterday, and it got me thinking, and I brought it up with Tom and Tony this morning, but I'm curious about your view. Speculative capital is always going to find a place to go. I feel like for the past several years, people have been waiting for the housing market to clear, for rates to go lower, or for prices to drop so that they can deploy capital back into housing. But for existing homeowners, if you've been waiting for rates to drop because you have a sub 4% mortgage, you've actually been able to save up a little bit of money over this time window. Maybe you were planning on moving, maybe you weren't. So what if there's a realization that because of all the tariff policy that rates are going to stay higher for longer at the long end of the curve? We're not going to get another significant pullback in mortgage rates unless there's recession. So might as well dig in with where we are right now. We need to start deploying this capital in other places if we're not going to use it in the housing market. We're going to put it into the bank, out of the bank. We'll put it into the stock market. If it's already in the stock market, we're going to take risk. We'll go into crypto. Do we think that maybe some of the recent market moves, if it's the gamma squeezes that we're seeing in some of these meme stock names, if it's the continued push higher by stocks in the face of ridiculous headlines, is it because there are portions of the economy that are broken and capital has no other place to go but into the speculative areas now?
I mean, I suppose so. What I was just thinking about is whether, because your premise is that there's a bunch of money that's basically been waiting to get more involved in the real estate business, yes?
Let's start there.
And that it's been waiting for lower rates or lower house prices, neither of which have materialized.
Correct.
And that it's sort of reaching a point of exhaustion where you're not, where you're excuse me, you're never going to get lower prices, or not in the immediate or intermediate future, nor are you going to get lower rates.
Right.
And so you're saying now they're going to untie the camels and head for another hill.
Maybe that's what's been going on in recent months with crypto, with the equity market.
Money that would have otherwise gone into real estate has come over. Could be.
Is that not so different? How do you explain
those short squeezes? How do you explain those crazy shorts, that one crazy short squeeze yesterday?
Oh, these are some of the hallmarks of a market reaching exhaustion, right? When pigs fly, because you can't get a good risk-adjusted return by making your typical trades. So you have to start going into portions of the market to punch lotto tickets. And if you have the capital to participate in a gamma squeeze type of situation, then it means that you probably have excess trading capital sitting around.
Meaning because you're allocating it into some real sort of, edge positions, basically, i.e., short open door technologies.
Right. Like I've accomplished enough of my year-to-date performance goals that I can afford to be a little bit risky with a small bit of capital. And if it goes sideways on me, no big deal. It's not going to really detract from my overall trajectory. And finding alpha in this market when everyone's long gold, short the dollar, and piled into the Mag 7s, it's all the same trade. So unless I want to be a contrarian and fade the world, I better be right with my timing. There was a really interesting tweet I saw that kind of triggered this chain of thought. It was from this guy who goes by the name of Clouseau Investments on Twitter, which can't speak to the efficacy of what they say, but I thought it was an interesting comment. Not calling a top here because of AI, yada, 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 but White House eliminates day trading regulations, poly market returns to the US, Robinhood enables 24/7 trading. The architects of the 2022 SPAC bubble are posting. CNBC guys have a crypto treasury play, and Wall Street bet meme stocks are crashing 40% from their highs. If you blow up later this summer, can't say there weren't signs. All I'm saying is what's going on is pretty crazy. It does feel kind of like 2021 in some regards here, where we're just running up in the face of what seems to be preordained misery, if it was inflation coming around the corner then, or whatever these tariffs are going to be.
But are you suggesting that this is also some sort of a, last gasp of bullishness before some abominable reality check emerges in the months ahead? Are you suggesting that reality check is the headwind of the tariffs that we saw in June is not just a one-time event, but rather is a broader economic underlying variable?
Thomas,
the likes of which Ilya Spivak would quite delight in?
I think that's what I'm saying, Thomas. I saw that we announced an agreement with Singapore today for our tariffs. President Trump has announced that instead of levying a 20% tariff rate with Singapore, the negotiations have yielded a 19% tariff rate with Singapore. Are we underestimating the risk that August 1st comes and Trump allows tariffs to go into effect for a day or two at these higher levels to make a point that he's serious, that he's not a chicken?
You're saying let them go into effect for a couple days and then extend them?
And then say like enough progress has been made to provide another 90-day pause?
I mean, sure, he could do that, but the market reaction, he doesn't want to see the market go down and then reverse that, because that taco thing is going to come back. And is he going to want the optics of people saying he chickened out because of a market reaction? So, when does the market start to price this in if tariffs actually, don't get that pause? The biggest risk is inflation actually coming up, rate cuts getting pushed back, and then a recession coming on. And then all this exuberance, is the last breath. So I don't know. I think as we get closer to August 1, the market's definitely, pausing up here, if you could call today that, but I don't see the market getting too fearful just yet of, this August 1st deadline. But we've had deadlines before and, flip-flopped either way. So it's hard to forecast what he's going to do.
Hard to forecast. I just don't have any confidence leaning long here anymore in the short run, which, given the pullback that we've seen in the NASDAQ over the past 24 hours, good timing to get out when I did yesterday. I see a bearish rising wedge up here, guys. I see a market that if we break below 23,100, this thing opens up a trap door for an easy 1%, 1.5% loss down to 22,800. And then if we lose there, it's stepping stones, 22,600, 22.3, 21.5, 21.6. And then August is a month with low liquidity, typically low volumes, but when there are bad news, they tend to be exacerbated, like we saw last August. I don't know, it just doesn't feel too hot right now. even though we're so close to all-time highs, and the S&P technically did close at an all-time high today in the daily chart. Doesn't look pretty, but we got there. All right, let's move off of stocks here. We've talked about them for the first 30 minutes. Let's move into the fun parts of the market where I think a little bit more money is being made today. Thomas, silver is working out really well here. I think that you and Dylan have not been involved in this trade as much as I've been recently, but the metals overall are working, and you're a resident commodity expert. Is today just a function of weaker dollar, lower yields, metals up?
Yeah, I think so. And then you're getting the equity markets flat, so perhaps some money moving over into silver and gold. I've been participating in silver for the past few weeks. This is the first week I don't have a trade on. Of course, I'd want to be in for this move. But if you're thinking that the dollar rebound is actually done and we're going to go and retest the early July levels and then potentially move even lower, silver, gold is, probably one of your surest bets to take advantage of, that kind of environment.
And is that what you think's on the table? Do you think that more dollar weakness is in the future, Thomas?
I'm not too confident that the bottom was in earlier this month. I think we could, make a move back down DXY like 96.4 around there and break down through it. If you're getting a loss of confidence, the sell the U.S. trade coming back if these tariffs go back on, concerns. I think the dollar can move lower. The only currency play I'm expressing that view on is long British pound. Yeah, so I'm not going to bet on it too hard.
Why the pound? Why the pound of all your options? Why the pound?
Oh yeah, next question.
I think it held at its late June level. You got a little bounce there. That's kind of where I got in last week, right where you were trading at the late June swing low. But the British economy, it's already been in trouble for a while, and now I think it's a little more ahead in the cycle versus the U.S. of going into an economic situation that, especially concerning debt, is untenable. So now those concerns kind of coming out or not coming to fruition as much as they were feared. But mostly it's a technical play. So I don't like the yen as much for that, and I was long yen up until a few weeks ago. Christopher got me out of that trade, but I don't think there's too much of a distinction between being long the pound or the euro. Either one I think works.
The pound is an interesting setup here because it did just get back above its 1 month average. You mentioned the move off of the late June swing low, which was a bullish engulfing bar, and sure enough, that's where we find the low. And perhaps the more disconcerting thing for dollar bulls, good news for dollar bears, the uptrend from the January, February, April swing lows. We crashed below that this last week, only to retake it today. And we're closing back above the 1 week and back above the 1 month. So check. The dollar looks in trouble from that perspective. It looks in trouble from the euro perspective. Dylan, I hope while you're overseas, your paychecks are in euros, not in dollars this year, because it's not good otherwise. And we find our yen. This is bad for me. Second day in a row, political unwind. Thomas, I am convinced that this is just a political unwind. And none of the problems that the yen had accumulated over the past few weeks have gone away. Would it be silly of me to dig into my pockets and go buy some out of the money yen puts here? Maybe play this both sides of my mouth, get short the yen and maybe long the British pound like you?
Yeah, I don't really like trading a currency on, a political situation, avoiding the worst case scenario. I think it's going to return to its previous downtrend and kind of break that level from back there in having trouble reading the monitor from all the way back here, but the lower support line you have drawn on there.
Basically just north of 0067.
If we break under there, I think you could see, the losses accelerate a lot faster. I mean, you mentioned multiple times how it's a crowded trade right now, so you have to get an unwinding of positions at some point, and breaking that support level would probably, cause rush for the door.
Dylan, the charts don't lie. We can't ignore the fact that the dollar index is breaking down again here. It feels normal, though, because yields are going down this week. So the past 2 days, I could argue that it's just simple dynamics of how the FX market's supposed to work. But gold up, dollar down. You said Sell America's coming back. We don't see it in stocks or bonds yet. What's going to be the catalyst that breaks us out of this stupor? Because it feels like we have climbed the wall of worry and continue to ignore worries when they try to get added back to the wall.
I mean, I just wonder to the degree to which you kind of hit on it earlier, where I think that what's today's date, July 22nd or something like that?
Mm-hmm.
That as we get closer to the tariff deadline, that the market starts to incrementally increase the pricing around the probability that maybe the tariffs really do happen, or maybe the tariffs really are, more consequential or at higher levels than we hoped. And I think that the place where you see the tariffs obviously manifest the most is in the U.S. currency. And so I just wonder the degree to which there is another kicking of the can, or a negotiating of the deal, or a reconfiguring of the structure of the negotiation, or however they say it is, that the actual implemented tariff rates on August 1st, once again, do not end up being particularly consequential, and then the degree to which that becomes the big dollar catalyst, particularly in a world where rate cuts are being delayed, not accelerated, which is not to be underestimated, and as a dollar support.
I think that's a good point. The market started moving in late March to price in Liberation Day, did it not? And the dollar started to get a little bit weaker, and the gold started to go up a little bit more. That was late March. If we're going to draw a corollary here, thinking that late July is like late March, then gold gets a little bit bid here for the next week. Dollar maybe comes off a little bit more until we get an official can kicking. That is. But if you've been looking at how this market's behaved otherwise, why not 10 days out from this deadline? Why not have a little insurance in your pocket? Which I guess brings me to what's happening in the S&P, because if we go out to August 1st, that Friday, and look at something like long the 6,200, short the 6,175, so a long out of the money put spread here, and whoops, we don't want to do it that way. We want to do it this way. Okay, risking one to make 7, 6, just as some insurance in the back of our pocket if Liberation Day comes around the corner. I don't think it's the worst thing in the world. Just the fact that the tariffs today, shocked that this was being bandied around as a victory. What if it's the same thing with the EU, right? Or Canada? Instead of 25%,
you're saying shocked that 19% was seen as a positive resolution in Singapore.
Yes, because from my worldview, I don't think tariffs are the most beautiful word in the English language. And I don't
the
think
market's at 5 to 10% expectation. So anything north of 10% that actually happens is alarming, basically.
Yeah, and I know the market's very much thinking like, okay, Trump's going to do 10 to 20% and we'll all move on. But there's a difference between a 10% tariff and a 20% tariff.
Indeed.
Or a 19% tariff. Has huge economic consequences.
Yeah.
So liquidity is not great right now. It's not fantastic, but time of day. But it's not terrible. Let's get some insurance in our pocket. We'll get this order working. If someone wants to give it to me that quickly, doesn't make me feel great, but I'm more than happy to take it for them. Little downside protection. I already have S&P 500 put spread out for the end of August, which I guess is slightly different, assuming the China deadline on August 12th. Is that going to get kicked down the road? August could be crazy. I'd rather have something in the equity market that leans short.
So
than
what
anything else.
what date are you going to lock in for your insurance policy for August? Why don't you take all of August?
Well, I have all of August. I have now August 29th and now August 1st. So I'm covered on both ends. I just think it's prudent. The market feels a little hot, and I don't like saying that as a bull, Dylan, because I've made my name with you over the past few years being the bull's bull around here.
And so what is it? Is it just the chart, just your technical view of the pattern of the charts that gives you anxiety? Like, is there anything else other than, like, why do you feel the caution?
The seasonality of the market. I can't think of a time in the past few years where August and September have not brought about a market decline in some form or fashion, or at least a pausing of the rally.
Mm-hmm.
And with volatility near cycle lows, as we see from the VIX or VIX futures, we can go to VIX or /VX. It just feels like everything is priced for perfection. So I'm not selling out of my long-term holdings, not at all. It's just I don't want to lean long deltas in my equity book at the moment. Unless it's the one thing that we've been talking about here recently. Well, two things. We did yesterday discuss the short squeeze potential for some companies. One of the names that we checked here, maybe some people took a gander at it themselves because the short float was over 50%. Rocket companies, they were up 6.45% today, Dylan. So, thinking about the signpost, testing our theory in real time, if pigs are flying, then it would mean that we're late cycle in this bull run because people are chasing crap. Today, we got more evidence of that. It wasn't just Rocket, but Kohl's was up 60-something% earlier today. This is a company with a very high short float in the high 40s. A bunch of these companies had performances like this. Let me just pull up my list once more. Who is the Locify? I've never heard of them before today. LCFY, Locify. They were up 19.8%. That is the most shorted stock in the country right now, for what it's worth. Children's Place, that has a 49.95% short float. That was up 33% today. Air Sculpt Technologies, that has a 49.21% short float. That was up 12.5% today. I mean, you're seeing it everywhere. Riley Financials, this float, that was up 15.2% today.